At Primark, one of the companies that they own. But Telecom Italia, I think, is the one that is catching my eye the most. This is coming after further M&A when it comes to a potential 15% stake by another Italian firm. We're going to see how that all shakes out at the open, Guy.
Absolutely. Talking of that open, it is almost upon us. It's time for the opening trade. So let's show you some numbers. As I say, we are expecting a negative story for European risk assets this morning. Let's take a look at the numbers that we're going to post first thing. The opening trade, FTSE's down. We'll see how much it continues to drop by. The IBEX is out early this morning. It's down by 0.7%. That is pretty much the benchmark number I think you're going to be looking at for a number of these indices this morning, down by 0.75% to maybe 1%. So maybe we're expecting further drops to come through for the FTSE 100 as it starts to open up. How does Europe perform in this kind of a market? Is it going to basically one-for-one mirror what we're seeing over in the United States? Is there going to be some divergence? I think that's a key question for PMs this morning as we watch what happens here in Europe. How much of a diversifier are European equities right now, and how much longer can this outperformance that we're seeing versus the US continue for? The CAC is down by 0.8%. We'll wait for the DAX in just a moment. Kriti, what is happening with the sectors? What's happening with the single stocks?
Well, the individual movers that are catching my eye are your sensational six, because if you right now are a heavyweight in Europe, you are selling off. I'll give you an example. ASML, LVMH, Schneider Electric, even Novo Nordisk, they are all taking a beating this morning in line with a pretty broad sell-off. 531 stocks in the red, only 52 in the green, and utilities are kind of the sole outperformer, high by 0.2% on a sectoral basis. But it does feel like it's a broad risk-off sentiment that isn't really kind of making any difference or any selection based on what kind of stock you're in.
Look at this. So up stocks in the Stock 600 this morning, 53. Down stocks in the Stock 600, 524. Everybody's on one side of the boat this morning in terms of what we are seeing. As you say, the heavyweights are where the damage is being done. ASML, ABB. I think ABB might be ex-dividend this morning. I need to double check that one. Schneider's down. LVMH, Rolls is down pretty hard. Big outperformers. The tech space is in there. You've got some of the defense stocks as well under a little bit of pressure. There are not many stocks to the upside. 60 stocks this morning to the upside, 524 to the downside.
Yeah, it really speaks, again, you mentioned it, it's the broad-based nature of this all, but I'm also seeing when you look at kind of the individual performers as well, and these, you're seeing it on the screen, the top 5 worst performers in the Stocks 50, you're starting to see it really spread the gambit. I mean, it's a lot of the tech names. You've got ASML and Schneider kind of fighting almost basically for the crown of which one's selling off the most. When you have Rio Tinto, you've got some banks in there and consistently moving. That is both a defensive sell-off and a cyclical sell-off from what I can see.
Absolutely. What you are seeing is the bond-sensitive areas of the market, though, maybe outperforming. Utilities are the only stock sector to be in positive territory this morning. Real estate is absolutely flat as a pancake. Telecoms doing relatively well. The kinds of areas you would normally expect to do better in an environment where yields are coming lower, and we're certainly seeing that with treasuries this morning, and it's ripping through into the European bond market as well. So that's where you are seeing people maybe hiding out a little bit. You've got the grocery stocks doing well, the food and beverage, the healthcare stocks. This feels like a defensive setup this morning.
It absolutely does. And I'm saying we're I guess getting an opening trade on the DAX as well. It's now opened lower by about 0.9%. So again, the sell-off is broad-based, even though traditionally when we see a sell-off in Europe, that defense sector, as you kind of mentioned, in Germany tends to be the outperformer. Not today. Today is
sell everything.
Yeah,
it does appear to be sell everything.
Exactly. Get out of it. Well, let's see if that's the right approach and bring in a true expert here. Chris Bitterly, head of Citi Global Wealth at Work, joins us around the table. Welcome to the show. Welcome back to London. Lovely to have you.
Good morning.
Good morning. You picked picked a great day to join us in that everything is selling off. What is the market reacting to here?
At least it's sunny outside. So the weather is good, but the market clearly is a little bit gloomy. I would say, I mean, when you look at the price action that we're seeing, it's very similar to what we've seen within the U.S. market. Anytime that you have utilities, kind of defensive sectors, real estate, consumer staples as the winners of the day, that's something that we're seeing within the U.S. market. And I think the big question really is this outperformance of whether it's Europe, whether it's Asia versus the U.S., is that sustainable when so many of these companies, their revenues are generated in the U.S.? So on average, I think the numbers for the U.K. and Eurozone are around 25%. You take some companies like in Asia, like TSMC, and that's close to 75% of revenues. So yes, there is a trade in terms of being outside of the U.S., but Wednesday's a big day in terms of figuring out what it actually means for profitability of these companies.
So how does that work then? If we're talking about companies, and I can appreciate that we don't have the details yet, but if you're talking about companies that have that exposure to the U.S., as you mentioned, do you sell them? Do you buy them? I'm still unclear on what that trade is. Is it a defensive story or that's more exposed, let's go domestic? How do you think about it?
We actually added exposure. We added international exposure into our portfolios in Q4 of last year. That was more of a story of concentration and diversification. So when you looked at the valuation disconnect between international equities and U.S. equities, when you looked at the fact that U.S. equities represent close to 65% of global market capitalization, but only 50% of the earnings, there is a reason for diversification. I think what the market has done, though, year to date, has really been significant flows out of the U.S. into European and Asian markets. And now the question is that just a trade, or is this really a sign of a longer-term investment? And I think for now, it's a trade.
Right. So what are you advising your clients to do, therefore? Is we gone too far? Does Europe do better if we continue to go down? Is it an outperformer, but only on a relative basis? What are you seeing?
I think having diversification is a good thing, period, in these markets. And it extends not just U.S. versus international, but also within having fixed income exposure within your portfolios. And so whether we
When's that going to work? When's that going to start working?
It has worked, actually. I would say having U.S. fixed income within your portfolios year to date, when you look at the reason our clients are not panicked is the fact that if you have fixed income exposure, if you have diversified equity exposure where you weren't significantly overweight the Mag 7, year to date, you're doing okay. You're not happy with your performance, but you're not seeing those big drawdowns, or you're not even experiencing anything close to a correction. So I think the major question here for those investors is, should I be adding exposure and buying the dip? And we are not. And so that's a hard thing to say. It is a hard thing to say. I know this 5,500 level within the S&P 500 is something that people are testing and watching. But I think the challenge is you have three risks. You have policy, which policy uncertainty, as we all know, insanely high, profits. So going into Q1 earnings, what are we going to hear from these companies? What is their guidance going to be with all of this uncertainty?
You think we're going to get guidance?
You know what's scary? I think that's actually a scarier point, right? Like if you, right now, someone guiding lower but having some degree of visibility, that's okay, right? That's just saying that we had lofty expectations and we're bringing them down. If companies start pulling guidance, that's a completely different story. And then the last piece, when you look at positioning, we have not seen capitulation. We have not, what did we get in the VIX? High 20s? And so when you look at those three things, policy, positioning, and then profits, the risk is not skewed in your favor.
Can I add another, or maybe two other P words there, which is kind of purchasing power? Yeah, purchasing power is going to be another one, because you're talking about margins, and you're talking about kind of how much guidance can people give. But hasn't this been a story so much for a lot of American corporates, but I would argue European corporates as well, where any increase, supply chain increases or policy uncertainty, they can just pass it on to the consumer. What are you seeing from that level, from this bottom-up approach? How digestible are price hikes should they come down the pike?
And so I think it depends on the company, quite candidly. So when you look at certain companies have that pricing power, it's also going to be a function of how strong your balance sheet is and your free cash flow generation. And so certain companies are going to want to be able to withstand some of that pressure to still maintain market share. But this is a real concern. And I know Chair Powell talked about inflation being elevated. He used the transitory word again. And he's saying, look, a lot of the rise that we saw in PCE was really due to the fact that people were accelerating a lot of their purchasing, which may be temporary. It may be, but then you're going to be able to see this whether it's solely in goods or whether what would be concerning from an inflationary standpoint is if you see it flow through to shelter and services as well, which is a different story.
So if you're an American stock, an American company, we'll call it that, is liquidity your friend right now?
Yes. Liquidity is your friend. I think whether you're an investor, liquidity, making sure that you have the right positioning, talking about asset allocation. If we're not buying the dip, having some liquidity such that when you do see a real spike in volatility or opportunity to buy, I think is your friend. And I think if you are adding exposure to companies, so if you're someone who has been significantly overweight cash, because this is the reality, you have certain investors, asset allocators, they're fully invested, but a lot of investors have been sitting on the sidelines. And their question is, when do I buy into this and how should I think about opportunities? If you're going to buy the dip and you're going to take advantage of dollar cost averaging in any way, it has to be on these huge free cash flow generating companies that can withstand some of this policy uncertainty.
But what is my signal for this to get back in again? There's so much policy uncertainty right now. As you say, it's kind of sky high. And there hasn't been capitulation. What am I looking for to start redeploying capital? What's the signal that you guys are watching for to make that decision? I would tell you a
couple of things that it's not, maybe.
Yeah, okay. Let's start there.
Yeah, narrow it down.
Let's narrow it down. So April 2nd, I don't think we're getting much out of April 2nd.
Okay.
I actually think Friday is a more important day in terms of employment.
Point. Yeah.
What are we going to see on Wednesday? We're going to see maybe some more information, but the market's not positioning for it. Maybe some of the sell-off is trying to position for it, but I don't think just the magnitude of the information we're going to get and trying to parse through and what that means for positioning, I don't think that's going to be a big event. Friday is important because I do think looking at the backdrop from an employment, so there's two things we're watching very closely. The employment backdrop in the U.S. market. Are you seeing an acceleration or deterioration there? This is going to be the first report that we get that's going to actually incorporate maybe some of those layoffs that we're seeing from the government.
Yep.
So that's something that we're watching. And then the other thing is all of this consumer confidence and the sentiment data, because that's something that can become a self-fulfilling prophecy. And you're seeing that if people are pulling back on spending and you're starting to see the cracks in some of that data, when we know consumer spending drives about 65%, 70% of GDP in the U.S., that's something that we're going to watch very, very closely.
But it's the upper end, and the upper end is tied to the stock market. So it becomes quite circular quite quickly.
That upper end, I think, drives, it's like the top 20% drive 40% of spending, and it's the top 10% of Americans own 90% of the stock market. So
there's a connection.
There's a connection, but I think the wealth effect, though, on one hand, you could almost make an argument that that part of the economy is immune to whether it's inflation, but actually seeing a deterioration in the labor market, which we haven't really seen, I think that's something that would be a signal that we are running into maybe not a contraction, but certainly a real slowdown in growth.
And we'll leave it on that. Chris, nice to see you.
And it's sunny outside.
And it's sunny outside. We'll take the good news there. Chris Bidley will definitely take the good news here in London when it's sunny. Chris Bidley, thank you very much indeed for joining us. Head of Citi Global Wealth at Work. Thank you very much. Okay, let's talk about what is happening in this market right now. As Critty was mentioning just a moment ago, centre of gravity here in Europe is certainly feeling like a dark place this morning. As you can see, big stocks across the continent are under significant pressure. Even Nestle. These are the kind of safe. That's the kind of the safe side of the core six is down by 0.8%. The Western family over at ABF having a tough morning as well. Joe Easton's here with the details.
So they are indeed having a tough morning, Guy. This as the stock falling around 4% in London. Now the CEO of Primark, Paul Marchant, standing down following a probe into his behaviour at a social event towards a female employee. According to a statement, he has apologised and admitted that he made the wrong move there. But that is a surprise for the stock, and it is selling off this morning, a pretty big decline for the owner of Primark, AB Foods, dropping 4.5% at the moment, a decent drop in that one. And another big drop, Pets at Home here in London, the company warning of subdued markets, people not buying enough goodies for their cats and dogs apparently, because that stock is getting hit pretty hard this morning. We're down almost 13% for Pets at Home today on a bit of a downbeat warning. Also talking about the rise in national National Insurance hitting their cost, so a double hit for that one. Then in terms of Aston Martin getting a boost, raising around 125 million quid, partly via selling more shares to Lawrence Stroll, the Canadian billionaire, but also looking to offload the minority stake in Aston Martin Formula One, of course, with Alonso, the driver over in Spain. He's their big star on that one, if I remember rightly, but that one getting a boost given the renewed funding for Aston Martin. AML, decent move for that one, up 5% this morning. Then in terms of banking, we've got news, ING getting into the mix in terms of the Italian banking M&A. Banca Sondrio previously had a bid from another Italian lender, and now we're getting a bid, potentially a rival bid, coming in from ING, but it is around 5 billion euros worth of cash potentially they're going to be spending on that one, so we're seeing ING dropping very slightly here in Europe today. Then in terms of software, a big move in terms of M&A. Fortnox, this is a company listed over in Sweden, getting a takeover bid at a massive premium. It's around a 35% premium, so we're pretty much coming up to that level today. This coming in from EQT, a consortium led by EQT. Fortnox does software for HR, accountancy, that kind of thing. It's getting a big move on that one today. Then finally, just wanted to end on the electrification stocks, because really interesting, this sector, of course, all exposed to data centers, and that has had a really torrid run recently, including a drop on Friday, and we're starting the week once again on the back foot. Schneider Electric, ABB, Prysmian, Siemens Energy, all of them lower given continued concern around data centers, probably a bit of a tariff play as well, but I thought that was an interesting note. All of those stocks starting the week in the red for the data center stocks here in Europe this morning.
All right, Joe Easton from our equities team, we thank you so much walking us through some of those early movers. Coming up, we are going to watch our what's going on over in France. Marine Le Pen will shortly find out if she is banned from running for president in 2027. We're going to have the latest for you next. Stick with us. This is Bloomberg.
Jobs Day, and Bloomberg has the report under surveillance.
This is another read on the U.S. labor market.
Workers are staying longer than you expected. How do firms actually deal with that new data point?
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
I do go back to what the lag time is between the soft data and the hard data. What's the lag data for the Doge effect?
That would speak to the anxiety of the labor market right now.
The March Jobs Report, Friday on Bloomberg. The multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, Mondays on Bloomberg. Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We are risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays at 9 p.m. Eastern Time, right here on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today. and what will likely be the headlines tomorrow.
Above all else, it's emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 12 p.m. Eastern, right here on Bloomberg. Context changes everything.
Welcome back, Monday morning, 18 minutes, 19 minutes into the session. Let's take a look at some numbers. Doesn't look particularly good out there this morning. Friday wasn't a particularly good session. Monday morning for risk assets, not a particularly good session. Let's just take a quick look at the breadth, because we were bringing this one to you a little bit earlier on. And we now have 560 stocks lower in the stock 600. 35 are up, 7 are unchanged, and 559 are down. The breadth is not good this morning.
You paint a grim picture. How in character? Let me bring some optimism to the market story here. With one trading session left in the quarter, U.S. bank stocks, one trading session into the quarter, U.S. bank stocks are on track to end their worst 3 months since the 2023 regional banking crisis. It's a very different picture for their European counterparts. Here comes the optimism. They're ending their best quarter since 2020. Here's to talk about this transatlantic divergence is Bloomberg's Charlie Wells. All right, Bloomberg's Charlie Wells.
That's his official title.
Yes, now we're making that. It's like your first name, Charlie Wells, is your middle and last. Walk us through the split. Why the divergence?
Yeah, I mean, look, let's start with the good news, which is that European banking story. And I mean, the macro setting is kind of different than what it's been really in the past 20 years. And I think you got to think about that German cash bazooka, right? You've got the spending on defense. You've also got the spending on infrastructure. And that is boosting banks like Deutsche Bank, of course. But it's also kind of a rising tide lifting all banks, as they say in the industry, I would assume, where you might have a little bit of inflation. This means that even though the ECB has been on this path downward with rates, they actually may be a little bit concerned about going too far, and that actually benefits bank lending, of course, so they could kind of hit that sweet spot. And you've really seen that momentum upward in Europe. Look across the ocean, and you see this kind of like, I guess it's what, like a upside down S, where we had this huge boost of enthusiasm after Trump. Those ideas about deregulation, ideas about an increase in M&A activity, even a little bit of excitement there in the beginning of the year, and then that shift, that sharp shift downward as this kind of trade uncertainty set in. And what do we know about M&A? We know that in M&A, you want a certain environment, and that is not what U.S. bank stocks are getting right now.
Year to date, European banks up 21.42%, by far and away the best performer. As you say, not the story over in the States, but be a bit more nuanced. Talk to me about big banks, small banks. Where is the pain really being felt?
So we got a little bit of a canary in the coal mine last week with Jefferies, and that is not looking good, right? So they always report early, and what we saw is that M&A activity not great, that investment banking activity not great, and capital markets business.
We were meant to have a great year for M&A.
We were supposed to have a great year.
It was going to be fantastic.
And look, we have finally got to a point where the M&A numbers are just a tad higher at this point than they were last year. But if you dig under there, you see that some of these big deals announced late in this quarter, Google, acquiring Wiz, for instance, have been kind of jacking that number up, kind of giving us a little bit of a false read.
So it's fascinating that the M&A story is coming at the same time as the buyback story, which usually happens in opposite times, in opposite directions. So I think the message, at least for me, has been the banks are flush with cash. What changes this? What flips this dynamic?
I mean, look, so you had Mike Mayo last week getting this really interesting point where, short term, he's a little bit, concerned about what the earnings picture could look like in about 2 weeks. Long term, still thinking in the U.S. there will be that super cycle, that banking super cycle that comes when that Trump administration finally gets to that deregulation push. On the Europe side, I mean, we've had so much talk about the spending. Now we've got to shift into execution. What does that actually look like? And then also we've got this trade picture in the background, and we have officials here in Europe just saying, trade is not just a U.S. issue, it's a global picture. So does that bring a little bit of negativity to this continent?
Bloomberg's Charlie Wells. Thank you very much indeed. Okay, let's talk a little bit about what is happening in Paris right now. We need to take you to the Paris courthouse and take you into French politics, because this is a huge moment. The next couple of hours, huge moments for French politics. Marine Le Pen, leader of France's National Rally Party, is about to find out whether she'll be banned from running for president in 2027. An immediate ban, which is, remember, being sought by prosecutors, is a very real risk for Le Pen and her party. if she is found guilty of basically diverting millions of euros in EU funds, which were meant to be for employing EU researchers, EU officials for the party, but only EU facing, not domestic facing, and that is where this embezzlement charge comes into focus. Le Pen has denied the allegations, but we need to get details on what could happen next. The perfect person to talk to, of course, is Caroline Conan. She joins us from Paris. Caroline, just the magnitude of what is about to happen, how important is this for French politics? How big a bombshell will it be if Le Pen is banned?
It would be clearly a bombshell, given she's never been closer to winning the next presidential elections in 2027. There are several scenarios expected at the Paris court over the next hour or so. One is, of course, she's found not guilty. That's unlikely. Another scenario is that she gets a suspended sentence, not applicable immediately, possibly some jail term that she could serve under an electronic bracelet or under house arrest. But, of course, the worst-case scenario for her, that was requested by the prosecutor back in November 2024 during her trial, is that she could face an immediate ban from running for office, meaning she would not be able to compete in the next presidential elections in 2027, where, as you know, Macron will not be able to run because he's already done 2 mandates. So, as you were mentioning, she's been accused of allegedly embezzling as much as 4.5 million euros of EU public funds between 2009 and 2017, along with 9 other former members of the EU Parliament, part of the National Rally. At the time of the prosecutor's request in November 2024, she said this was a witch hunt interfering with the democratic process. And over the weekend, she actually said that she was not nervous about the verdict because she could not imagine, she could not believe that the judges would sign today her political death.
Caroline, we've got about a minute, and as you were speaking, of course, we have live pictures of that Parisian courthouse as well. Walk us through the backup plan here for the RN. What happens if she becomes ineligible?
Well, she's been very high in opinion polls, 37%. This is the latest poll we have from this weekend. If she had to face, for example, the former Prime Minister, Edouard Philippe, obviously the plan B will have to see the National Rally president, Jordan Bardella, is an option. He's only 29 years old, though, and he doesn't have much experience yet. Politically, he's been cited many times as her possible prime minister, never tested yet in any opinion poll as a presidential candidate. So, of course, there is a lot of question whether also she would use this, possibly the National Rally would use this to play the victim. I was reading earlier, we could see a sort of Trumpification of the French politics, just like we saw with Donald Trump after the Capitol riots.
Absolutely. Bloomberg's Caroline Conan joining us from Paris to walk us through the political story there. We thank you so much. Guy.
Coming up, we're going to talk gold. Continues to move higher. How long does it last? Maybe this week continues that trend or turns it around. We're about to find out. We'll talk about it next. This is Bloomberg.
of people who come into private credit for the first time, do you think that they maybe misunderstand a few things about the industry, given that it is private and they don't see the marks every day? Do they think that that means that things don't move around much in price, that they are inherently safer?
Don't get me down the marking rabbit hole. I actually think just because an asset class doesn't trade doesn't mean the value of that asset class doesn't actually move. With private credit, the biggest challenge is your ability to create liquidity when you make a mistake is more narrow because you're the owner of the asset, and likely maybe the sole owner of the asset or one of a few people of the owner of the asset. So there's not a lot of people following that asset that can provide you liquidity. So you own all your mistakes. Ultimately, when you generate that return, it's going to be whatever your return is, less losses.
In case you missed it, on Bloomberg Open Interest.
Finding some sense in these crazy markets.
I hope they turn around, though. You know, because my 401k, I'm looking at my 401, my retirement, and I'm thinking, God, how many more decades do I have to
Your retirement account. I cannot say that enough. Set it and
you need
forget
to find a new target date.
I need to find maybe a new future. I'll be standing next to Paul Sweeney as a greeter at Walmart, you know, in our 70s. And
Don't miss Open Interest live weekdays.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
This is the opening trade. We're about 30 minutes into today's session, seeing red on the screen, although perhaps bouncing off the lows we saw just about 15 minutes ago. You are seeing pain, however, across the equity session. A lot of this guy has to do with just the volatility coming out of Washington, D.C. right now.
It was a crazy weekend. There was a lot happening. There was a lot of commentary.
Ahead of a crazy week.
On a lot of things. Yeah, I'm trying to get your head around the NBC interview and then the comments on Air Force One. And anyway, I suspect, as you say, we're just warming up for a busy week. So President Trump over the weekend threatening, quote, secondary tariffs on buyers of Russian oil if Vladimir Putin refuses a ceasefire with Ukraine. However, that was the NBC story. Then we get Trump talking to reporters on Air Force One, slightly toning the comments down. Take a listen to what he had to say.
You're talking about Putin. I don't think he's going to go back on his word. I've known him for a long time. We've always gotten along well. He considers Zelensky not credible. He's supposed to be making a deal with him, whether you like him or you don't like him. So I wasn't happy with that. But I think he's going to be good. And I certainly wouldn't want to put secondary tariffs on Russia, but if they were put on, it would not be very good for them.
The president toning down earlier comments. So in the NBC interview, he said, quote, he is very, very angry with Putin. He used other language, but we'll just go with very, very angry this morning. And he threatened secondary sanctions. What kind of impact would that have on the oil market? Do we believe what is happening here? Bloomberg's senior executive for energy and commodities, Will Kennedy, joining us around the table this morning. Not much reaction in oil this morning. But how would secondary sanctions work? Presumably India and China would be the most exposed here. It's just so hard to get your head around all of this. Yeah. Walk us through the process.
Well, it's hard to say exactly. This idea of secondary tariffs is a new one that exists in the president's mind. He's mentioned it before with Venezuela. There seems to be some, are these sanctions, are they tariffs? Are they a combination of the two?
I probably should have said tariffs, but
if you take, well, I mean, it's hard to work it out exactly, but if you take it at face value, it would mean that anyone who buys Russian oil would be facing tariffs of 25%. And of course, that firmly puts, I think, most importantly, India in the firing line, which since the war in Ukraine and Europe's stopping buying most Russian oil, has become the #1 buyer of Russian oil, and that does tend to take US sanction and trade policy very seriously. So it would, if it happened, and I think that's a very big if it happened, would pose big difficulties for India, which is very reliant on Russian oil to power its economy.
Can you just explain to our international audience, and more importantly me, what a secondary sanction actually means?
Well, I think we've never seen this proposal in detail and how it would work, but if you take it on face value, is that anyone who buys that oil then would face sanctions from the US, tariffs rather, as punishment for having done something that the US had asked them not to do.
So about Iran, because that was the other thing that came into play this weekend as well.
Look, I think Iran is a very live issue for the oil market. Clearly, the Trump administration has been quite clear all along that it wants to put more pressure on Iran to forestall its building a nuclear weapon. Trump has said on several times, I'd like to do a deal, but if not, we will come down hard. So I think the oil market is still very alive to the prospect of more pressure. And you've seen sanctions gently ramped up on Iran in recent weeks, more pressure on Iran and some bearing down on their oil exports, which had rebounded strongly in the latter part of the Biden administration. So I do think that is an issue. Whether that it's tariffs, sanctions, whatever, we do expect more pressure on Iranian oil exports from the Trump administration.
All right. Well, Kennedy, Bloomberg Senior Executive Editor for Energy and Commodities, walking us through the oil story and, of course, where Russia and Iran play a role in that. Let's stick with the commodity space because there are several others that are on the move. Let's kick it off with gold here, starting the week with a fresh record high. I'm looking at over 3,100 on the precious metal. This comes ahead of those expected tariffs from the United States later this week. Does it sustain, though? Let's ask a metals and mining commodity strategist over at Morgan Stanley. Amy Gower joins the program. Amy, this move, we've been talking a lot about whether or not gold is ultimately just a defensive haven hedge, or whether there is a valuation, a kind of get in at the right time element to it. Where do you stand on that?
Yeah, I think, look, this move higher in gold has been building for quite a long time, and actually many of the points at which the market and many analysts have thought it's peaked, it's been able to carry on rising, and I think that's because there's sort of two different stories driving gold here. So one is the physical demand. That really started to shift in 2022 when we saw central banks buying a lot more gold. They doubled their rate of purchasing from the previous decade, and that has sustained. And then more recently as well, investor demand for physical bar and coin, and even ETFs starting to step in the last few months. So that's actually new inflows to gold coming through here, and arguably plenty more to go here. And then there's also the macro angle to gold of, how does it compete in an investor's portfolio against rates and equities and bonds? And that should be arguably getting better from here. We've had a tough macro backdrop for gold with this high interest rate environment. So as these come down, actually that arguably should be a tailwind for gold. So as long as the physical can hold and then the macro factors come through, we would say gold hasn't peaked yet.
Dive us a little deeper into the interest rate dynamic there, because you mentioned it. If the interest rate expectations come down, then therefore gold rises. But the Fed isn't exactly leaning in that direction. The ECB is. Other parts of the world are. The UK, maybe. The BOJ, certainly not. And the Fed is really on pause. So that expectation that would be a tailwind to gold, hasn't that just kind of bottomed out?
Yeah, so I guess you could say the rates are still quite elevated relative to where they were before this rate hiking cycle. So it's really about the direction of travel here. Have we peaked, and are we generally moving lower? And that does make gold relatively more competitive. As you say, it may be slightly on pause this year, and that's where that physical demand story remains important. So we do also need to see that holding up. Those ETFs have just started to see inflows, the gold holding ETFs, and so we would look to that sustaining to believe that this rally continues to have legs.
How self-limiting could this be at the kind of price point that you think gold will peak at, so sort of 3,300? If we get there, what happens? What is it that limits the rally from there?
Yeah, so our bull case on gold goes to sort of $3,300, $3,400 an ounce this year. I think, you know, whenever a commodity price rises, we do start to worry about demand destruction, and particularly when something's moving very, very quickly. You know, for example, jewelry, that's around double the size of what central banks are buying each year.
Yeah.
And often when you go to buy jewelry, you go with a budget. You don't go with an amount of gold you necessarily want to buy. So you do naturally get that effect coming through. You get more recycling supply as well. And even central banks, you know, we've seen the Reserve Bank of India pausing in both December and February. So sometimes we might need to see a bit of stabilization, I think, for that flow to continue.
What happens in other markets around, the markets that orbit around the gold market, silver, platinum, palladium, all these other markets? What is happening there? Are we seeing the same effects? Silver has an industrial use as well. Is it more complicated when I get away from gold? Is gold the easiest kind of pure play in this story, or are there others that I can work around as well?
Yeah, so largely the central banks aren't buying the other precious metals, so you haven't had that tailwind, but you have had still good sort of that precious metal haven effect. You do see that, particularly silver has kept up with gold, but I think really then you start to differentiate based on their industrial uses. So silver's been very strong, largely because we've also had good fundamentals. So we've had mine supply struggling, we've had very strong solar installations globally. That has all tightened silver, drawn down inventories. Whereas platinum and palladium have lagged, and that's been as we've seen this switching in electric vehicles using less PGM catalysts. So I think we should also be mindful of their separate fundamental stories, but so far silver is very much keeping up with gold.
Well, let's talk about another metal if we can and go to the copper story. Guy and I were talking about whether or not copper is responding more towards the fiscal kind of impulse in China or perhaps more to the tariff threat out of the U.S. Where do you stand on that?
I think that the big story for copper really has been around tariffs in the US this year. So copper, I think, has exceeded many people's expectations. Year to date, COMEX up around 30%, and the LME benchmark up around 11-12% as well. And I think that's really been the expectation of tariffs, and arguably that changes once tariffs are actually introduced. So the expectation of tariffs has created a big incentive to ship metal to the US. This has tightened markets outside of the US. We've seen inventories drawing down, and we've seen premiums tightening, and then as tariffs are actually introduced, that incentive to ship that metal goes away. And we heard on Wednesday last week these tariffs could be in place within weeks, not months, with the Section 232 investigation ongoing. So at this point it gets quite risky to put metal onto a ship and send it to the US in case it doesn't arrive on time.
Amy Gower, Head of Metals and Minings of Commodities, we thank you so much.
Okay, let's take you to Paris. I want to take you inside the court building. Marine Le Pen is arriving for the culmination of the case that has been brought against her. This is a pivotal moment in French politics. We will see that result shortly, we think. As it happens, we will bring it to you. But Marine Le Pen is now in the building, and we are counting down to what we are going to get out of that French court.
At stake, the future of French politics in 2027. Is there a backup plan? There may not be. We're going to give you the latest, as Guy said. Coming up on the program, a new base for EasyJet opens today at Southend Airport. We're going to be speaking with the CEO, Kenton Jarvis, coming up next. This is Bloomberg.
is Baltimore so important to you?
It's our state's largest city. And if your state's largest city is not thriving, your state can't thrive. And that is just a mathematical equation, because the only way this is going to be Maryland's decade is if it's Baltimore's time. And so that's why we did focus on things like being able to extend the Orioles lease and make sure the Orioles could be here for 30 years. It's the reason we focus on things like the Preakness and keeping the Preakness in Maryland for generations to come. While we've invested in the convention center, the reason we focused on housing and getting rid of the vacant housing, the reason we focused on violent crime. And now Baltimore is having amongst the most precipitous drop of anywhere in the country when it comes to homicides and non-fatal shootings and carjackings and auto thefts. So if you can have Baltimore thriving, your state is going to thrive.
So if somebody's watching this and they're not from Maryland, but they want to know a little bit about Maryland, what would you encapsulate in a paragraph or two about what people should know about the state of Maryland?
I would say Maryland really is American miniature. You tell me what you want to do. And no matter where you're standing in the state of Maryland, I can tell you where to have a world-class experience within 2 hours. We're the home of innovation. We're the home of Johns Hopkins University, the home of the NSA, the home of NIST. We have so much to offer in the state of Maryland, and I think it's one of the reasons that people are so excited about the growth trajectory we're on.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Welcome back to the opening trade. About 44 minutes into today's session, and we are seeing red across the screen. There is nervousness in the market in risk assets, from stocks to bonds, even to the currency picture. We'll throw in a little bit of commodities in there as well. People are worried, and you can see it reflected in today's trade.
The weather outside, as Christian Bitter put it a little bit earlier on, is lovely, though. So that should be maybe the jumping off point for our next conversation. I want to take you to sunny Southend. EasyJet opening a new base there today at Southend Airport, this ahead of the busy summer travel season. How busy will it be? It, of course, comes as we see rising global uncertainty over tariffs. Is that going to have an impact on consumer confidence? What is happening with consumer confidence, both here in the UK and across Europe? Well, if you want to know what's happening in the global economy, or in the European economy, I would say ask an airline CEO. So let's do that right now. The CEO of EasyJet is Kenton Jarvis, and he joins us from Southend. Kenton, congratulations. Thank you very much indeed for joining us from sunny Southend. Look, you're opening a new base, one of many here in the UK. Should I take this as a sign that you believe that consumer confidence is fairly good right now?
Thanks, Guy. Yes, we're here in sunny Southend. It's a beautiful day here. And this will be our 10th base that we're opening here in Southend. We're going to base 3 aircraft here, and we're seeing good things for the UK. We continue to invest. Last year, we opened a base in Birmingham, added 3 aircraft last year, and we're adding another 2 this year. And we continue to add aircraft into the UK. We've got another one going to Bristol, one into Liverpool, Manchester, and Edinburgh. But yeah, very happy to be here in Southend.
So you still see positive things for the UK, for the aviation market in the UK. Others in your industry, and I'm of course talking about your oppo over at Ryanair, maybe pouring a little bit of cold water. You paint a more positive picture, Kenton. Is that the right way of reading it?
Yeah, I mean, we're seeing the bookings for this summer, and they're looking good. Bookings are ahead at this time, and we've obviously seen good growth continue for EasyJet Holidays. We advised the market that would grow by about 25% this year, and it's certainly keeping up with that.
In terms of what is holding you back right now, what is it? Is it the availability of aircraft? Is it the availability of slots to operate from? You're operating out of Southend. Would you rather be operating more out of Gatwick or other hubs that you've got across Europe? What are the limiting factors? What are the constraints on EasyJet's growth at the moment?
Well, I mean, obviously both the OEMs, Airbus and Boeing, are struggling with production. We were slated to get 9 aircraft this year. We've had 8 of them. The 9th one is going to arrive in advance of the summer, so we're fortunate from that perspective. In terms of slots, great to be able to open an airport here in Southend, but we see other opportunities. Tomorrow we're opening a base in Rome for Mancino, and then on Wednesday I'm actually opening the base in Linate, which is a great opportunity to fly from the centre of Milan. So we continue to look for opportunities and are growing where we see them.
Kenton is Creedy in London. Speaking of those opportunities, let's talk about your view on Heathrow. I know you've previously said that you could be interested in a potential increase in capacity with a 3rd runway in tow when it does openly open up. Other airlines have talked about fees and a regulatory structure being major issues. Is that a concern you share?
Well, I mean, it's a bit early for us to be talking about Heathrow. The 3rd runway would obviously give that potential. Right now, Heathrow is a very constrained airport, and we would only be able to get a couple of aircraft in there, which just isn't worth it with the marketing cost to let everyone know that we're in Heathrow for 2 aircraft. Clearly, if a 3rd runway's built, then that would open up a lot more capacity and enable us to base there at a scale that would make us relevant. And that would be a great opportunity for us because obviously it's mainly flag carriers in Heathrow, and it'd be a good opportunity to bring in an airline providing affordable fares.
Kenton, what was the lesson for you, or perhaps your takeaway from the recent power disruption at Heathrow?
The lesson is more for the airports we do operate from, and I've obviously spoken to Gatwick and others to check on their resilience measures, but I'm not close to Heathrow because we don't operate from Heathrow, so I'll have no more information than you would.
Kenton, let's talk a little bit about what is happening with sustainable aviation fuel. I was down in Toulouse last week at an Airbus event. SAF was a big subject there. Obviously, we've started to see blend mandates coming into Europe this year. The question now is, and this was the question that was raised at A4E last week as well, is whether or not actually we need to pare some of those back. The availability of SAF is now becoming a problem. It is very, very expensive and looks like it's probably not going to come down in price anytime soon. Do you think it's time for Europe, for the UK, for others with blend mandates to reconsider maybe some of those targets?
I mean, at the moment, we're required to blend 2% SAF along with our aviation fuel, and there is enough supply for that. We're finding enough supply for that. The mandate ultimately is on the fuel majors, and as airlines, we'll only be able to buy what's available in the market. So the kind of advice would really be for governments and the fuel majors to look for the solutions to ramp up the supply of SAF, because unless they do that, then it will obviously be a challenge to meet those mandates.
But at the moment, the issue is that it is expensive. And if you continue to push those mandates forward, it does look as if airfares are going to have to go higher. Is that just something that is inevitable now? Guillaume Faury was telling me this last week. It is inevitable that flying is going to become more expensive if we continue down the track that we're on at the moment. You are a relative low-cost operator compared with some of the obviously the big players in terms of the long-distance players, I should say. Do you think flying is going to become more expensive if we continue on the current track that we're on?
I mean, at the moment, SAF is 3 to 4 times more expensive than jet aviation fuel. But in part, that's because there's very limited supply of SAF. And I think that's why it's upon governments and fuel majors to find the mechanisms that will promote much more of a scale up in the manufacture and supply of SAF. And then I think if there's a healthy supply, then the market should be able to correct the price. But right now, if it remains 3 to 4 times more expensive and the mandates come in, and there is enough SAF to buy, but it's at that cost, then that will unfortunately make travel and flying more expensive.
Kenton, you're relatively new to the job. I think that's probably a fair way of putting it. Obviously, you've got a long history at EasyJet, but you've now taken over as CEO. Is this a continuation? Are you continuing with the strategy that obviously the company has operated under? Are you getting any surprise? How's the first year going, I guess is the real question that I'm asking. How's it going?
Thanks a lot, Guy. Yeah, I'm really enjoying it. Thanks for asking. Not quite 100 days in, and I've used that time to get out and around in the network. I mean, one thing that is really I'm convinced of is that our people are the differentiator here at EasyJet. That kind of warm welcome in the sky, the warm welcome now on the ground, and the engineers that we have, along with the crew and the pilots, really make the difference. And it's been a real pleasure getting out to see them all. As you say, I've been at EasyJet a number of years. I was the CFO before, so I helped co-create the strategy that we're following. Still think it's the right strategy. Last summer, we had our record summer. That culminated in the second best financial performance for this airline in its history. We see EasyJet holidays continue to grow. We're expecting it to grow another 25% this year. We continue to look for opportunities to expand the network. So I just want to build on the success that we had last year and see where that can take us.
Great to see you, Kenton. Thank you very much indeed for joining us from sunny Southend. Why would you need to go anywhere else is my question on a sunny day in Southend. Kenton Jarvis, the EasyJet CEO, thank you very much indeed. Let's talk about what we've got coming for the rest of the week.
We are...
Apart from our travel plans.
I was about to say, I kind of want to go to Southend. That seemed very, very nice. We've got a roller coaster in terms of the week ahead. Plenty of data on both sides of the Atlantic, from CPI to manufacturing data, all really counting down to payrolls on Friday, and somewhere in there we get some tariff content as well. So what moves the markets more? Luckily, I don't have to answer that question, but Valerie Keitel does.
No pressure.
Yeah, no pressure. I mean, walk us through it. What's on your radar? How does this show up?
Yeah, well, to me, it seems that the payroll print on Friday just seems light years away at this point. We have to get through Trump's tariff announcement to come on Wednesday when it comes to those reciprocal tariffs. But I want to talk a little bit about the recent correlation that we've seen in the stock and bond market. We have the first quarter in 5 years where we've seen a negativity in the stock market cause a rally in treasuries. We've not actually seen that since March 2020. And with everybody talking about a recession, kind of opens the door up to talking about, do we think whether this traditional correlation will continue? Because if we do head into a recession, Guy, we are heading into a recession with a deficit already 6 to 7% of GDP. And deficits tend to balloon, maybe even double when you head into a recession. So do you really want to be buying treasuries into a recession if the deficit reaches 13%?
Because there's automatic stabilizers. Now, the US doesn't have the same level of automatic stabilizers that you have here in Europe in terms of the social welfare bill. How big could it get? What could issuance look like in that kind of environment?
I mean, it could look huge, right? If we look
and where would it be?
If we look traditionally, the deficit climbs nearly 5 to 6% of GDP during a recession. So that's a 13% GDP of a deficit. And I guess traditionally, if you think that we're headed into a recession, you just close your eyes and buy the 5-year note. But this time around could be different.
The Fed would be cutting aggressively, presumably.
Well, let's hope so, right? Let's hope so that they instead, you know, what Powell told us in his press conference is that they are willing to almost look through a bit of tick up in inflation to protect the labor market. We do get labor market data on Friday with payrolls, right? I think the market might in some way want a weak number because in some way we want to know that the Fed put is still there, even though inflation expectations are rising. I think something could help the equity market in a perverse way.
Give us something, Jay Powell, just literally anything. But it brings us back to the point of how does the Fed even view tariffs? Because it wasn't the expectation that Jay Powell would put some sort of March 2019, some sort of insurance cut in the works if growth was still the focus. And yet we're still talking about inflation being the focus. Is there a credibility of the Fed question here?
Look, in some ways, yes, right? I mean, if he declares that the rise in inflation due to tariffs is transitory and cuts into that, obviously it could prove not to be the case. But if we look at all the analysis that the Fed has done, is that this will impact growth in a more negative way, and they are more worried about the labor market. But they have to, in order to do those insurance cuts that you talked about, Kriti, they need to see either a tick up in the insurance of the unemployment rate or some weakness in the labor market. So that's what they're looking out for. And in some way, maybe that'll be a good thing if we get weakness in the labor market, right? Because then we have Powell saying that he's ready to cut.
Val's definitely looking for the glass half full trade.
Spoken like a true markets gal.
That just about wraps things up. We've got a busy week coming up. There's an event coming up very shortly, though, you want to pay attention to, and that is happening in Paris. Let me just quickly show you a live shot from Paris. This is the outside of the court. We're inside the building, but outside the court. We're about to get the ruling on Marine Le Pen's political future. That is coming up very shortly. The Pulse will handle that for you. We will bring you that that as soon as we get it. Key moment for France coming up. That wraps up this show. The Pulse is next. This is Bloomberg.
up-to-the-minute news,
technology news, geopolitical news,
economic news,
financial news,
bringing you the latest news in private markets
whenever,
and wherever it happens.
In Washington, Beijing,
Cape Town, South Africa,
Las Vegas,
Davos, Switzerland,
Rio de Janeiro, Brazil,
the south of France, and this
is Bloomberg.
Bringing you the latest in tech and AI news whenever and wherever it happens. I'm Tom McKenzie in Paris, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. It's Jobs Day, and Bloomberg has the report under surveillance.
This is another read on the U.S. labor market.
Workers are staying longer than you expected. How do firms actually deal with that new data point?
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
I do go back to what the lag time is between the soft data and the hard data. What's the lag data for the Doge effect?
That will speak to the anxiety of the labor market right now.
The March Jobs Report, Friday on Bloomberg.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show, weekdays at 9 p.m. Eastern Time, right here on Bloomberg. Context changes everything.
The global sell-off deepens as traders brace for more U.S. tariffs. Donald Trump rules out exemptions, saying all countries will be hit on April 2nd. The U.S. president also lashes out at Vladimir Putin, threatening secondary tariffs on buyers of Russian oil if he refuses a ceasefire with Ukraine. Plus, a verdict due in the trial of Marine Le Pen, the national rally leader, could be barred from running for French president in 2027 if found guilty. Now, good morning, everyone. Happy Monday. Let's take a look at the European markets map. There's, of course, a lot going on when it comes to geopolitics. That's translating a lot through some of these asset classes as well. Now, stocks definitely falling. Investors seeking the shelter in gold and treasuries ahead of President Donald Trump's deadline for new global tariffs. We're seeing quite a lot of pressure across the screen. The CAC 40, the FTSE, the MIB over into the all down. Now, the risk of tariff linkage damage has also propelled the S&P 500 to its worst quarter since 2022. So across assets, let's go straight to what we're seeing in U.S. futures. Now, because of this, again, the risk of tariff-linked damage, the S&P, I think, saw about $5 trillion wiped off of its value from a February 19th record high. Euro dollar, you can see 108.33, and then crude. We use Brent crude because we're in the UK, $74.27. So for the conversations that matter and the insights you need, let's get started.
And market movers. This is The Pulse with Francine Lacqua.
Now, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, we have a lot of news to get through. Just one of the latest couple of news that's coming out there's a recalibration of, for example, Brussels, but also Europe and France now trying to fine Apple. So France finding Apple 150 million euros doesn't seem huge, but there you go, over its iOS app data tracking consent. So we'll see whether this then goes to Brussels and becomes a lot bigger. Now, President Donald Trump says he plans to impose so-called reciprocal tariffs on all countries on Wednesday. Now, his comments to reporters on Air Force One tempered down speculation that some nations could be spared.
You'd start with all countries, so let's see what happens. There are many countries involved. I haven't heard a rumor about 15 countries, 10 or 15.
So you're starting with all countries?
Well, essentially, all of the countries that we're talking about. We wouldn't be talking about all countries. That's not a cutoff.
Now, Trump also threatened to quote secondary tariffs on buyers of Russian oil if Vladimir Putin refuses a ceasefire with Ukraine. Trump says he still trusts Putin.
You're talking about Putin. I don't think he's going to go back in this war. I've known him for a long time. We've always gotten along well. He considers Zelensky not credible. He's supposed to be making a deal with him, whether you like him or you don't like him. So I wasn't happy with that. But I think he's going to be good. I certainly wouldn't want to put secondary tariffs on Russia, but if they were put on, it would not be very good for them.
Well, let's discuss all of this with our panel. Joining us now, Rosalind Matheson, our EMEA News Director, Rachel Evans, our Managing Editor for FX Rates for US and EMEA, and Marcus Morris-Eaton, Portfolio Manager for European and Global Growth Equities at Alliance Bernstein. We assembled our A-team to try and face the week that is. It's only Monday, and really the big day, Roz, is April 2nd. It feels like Donald Trump is on a combative mood.
Well, certainly he does seem to be that way, but also what we can see from those comments overnight on trade is that it feels like things are still very much in flux, and there's a lot of conversation probably still going on, even towards tomorrow and Wednesday, about what exactly these reciprocal tariffs are going to look like. We know very little for sure in terms of like who's going to be hit. Is it truly everyone? How are they going to be hit? What's the organization for paperwork even when they do get hit? There's just simply a lot we don't know, and maybe some of that is deliberate, but some of it also seems to reflect the reality that there are ongoing conversations still happening in his administration to the 11th hour to try and ascertain what to do and then how to make it work.
Yeah, and whatever happens, Rachel, is that actually markets don't like it. I mean, we see stocks falling, and there's, the gold and treasuries are now the shelter more than ever.
Yeah, and I mean, this has really kind of been taking off since like the back end of last week. We have been sort of seeing people starting to look through some of the noise around tariffs, a bit of a sense of, we need to see the sort of whites of the eyes of tariffs before we actually act, because there's been so much, to Roz's point, uncertainty around exactly what will come through, and then some flip-flopping and U-turns about some of the previous tariffs that have come in and then been taken off. So folks had wanted to kind of really see the reality, but I think as we've got nearer and nearer to this deadline, and there's been not really that much in the way of kind of suggestions that it won't be a very broad kind of action, people have started to want to take some risk off the table. It's not kind of a full-on route as yet, but it's definitely been a sense that there is caution in the market and wanting to take money out of play.
And Marcus, I mean, we're therefore probably expecting more cuts from the Fed, or certainly that's what the market is betting on.
Yeah, I think that, to be honest, it's all up in the air at the moment, though. And as the two ladies said, it's a dangerous game to bet and forecast these tariffs, because on the one hand, we have to forecast what's going to be announced tomorrow. But then the one thing we know for certain is that will be a negotiating position. And from speaking to US corporates, it's very clear that this lack of visibility around tariffs is really creating decision paralysis. So I think it will be good for everyone when we get greater clarity on the tariff regime, and companies can then invest for the future, understanding what the landscape looks like.
Yeah, Goldman Sachs, I think, economists there were predicting 3 rate cuts at both the Fed but also the ECB, really changing their previous forecast. Have you changed any of your forecasts?
No, we haven't yet, because as I said, it's a very dynamic situation. We need to understand what tariffs are actually announced, what are enacted, and then the corresponding impact on inflation. So we would rather focus on the underlying corporates themselves that can manage whatever policy is enacted.
Rachel, I mean, it does seem like, if you're the Fed right now, you're in a wait-and-see situation, but it's not looking pretty.
Yeah, I mean, there's a lot of kind of different issues that the tariff situation throws out. Number one, you're going to have potentially a growth hit. We've been seeing a lot more talk about recession, and what do you do in that sort of situation? Well, buying treasuries might be a good way to do it. But then also, to Marcus's point, the inflationary picture. Do you start to see price pressures kind of picking up as a result of tariffs? We saw kind of a lot of headlines over the weekend about sort of people going to car lots in the US looking to buy cars now because they worry that there are going to be sort of like higher prices passed on from those automaker tariffs. So I think if we start to see those kind of tariffs broadly impacting prices, then that has an inflationary impact, which would be bad for bonds. So you have this kind of like push-pull of, does this hit growth or does this hit prices? And what does the Fed then do about it? Because it would cut to support growth, but you'd want to keep sort of a more kind of higher rates if you were to try and kind of tackle price increases.
And we're just hearing actually from Mr. Panetta from the ECB saying, look, the fight against inflation is not over. Monetary policy needs to consider a weaker economy. When does Donald Trump actually sit up and take notice, Ross? Does he again look through all of these market moves?
Well, he keeps saying that he is, and that he and his administration are not paying attention to markets, but they say it so often you have to wonder if they truly are, because they keep reminding us that they're not. And how many times do they have to say that? And obviously he's a businessman, so he wants to take the mood. He's very responsive, to what is the mood amongst ordinary Americans. They are his bread and butter. American companies, again, who are in his ear a lot about some of this, including the auto companies on the auto tariff side. And therefore he is, to Marcus's point, a negotiator. And so he needs to factor in, how is this being received? What is my position? What can I change? And therefore he is someone who can change his mind very quickly. We've seen sometimes within a matter of hours. So he's obviously paying attention to where the market's at and where rates are too.
Rachel, the million-dollar question is that this could be a little bit of pain now to make the U.S. better off, which we know the president has an issue with, right? Saying the U.S. has been taking advantage for a long time. Over the last couple of days, we also hear about this Mar-a-Lago Accord really coming up at the forefront. Like, what do we do with that?
Yeah, it speaks to just kind of like how much noise and how many different things you need to process, because there is that kind of potential that Trump is sort of like indicating down the line, you're going to have to suck it up markets for now, because give it kind of, when they kind of enact all these reforms, a couple of years down the line, lower spending, all of that could be a positive for markets. But when you actually then sort of like look at all of the different impulses, this idea of a Mar-a-Lago Accord designed to weaken the dollar by encouraging overseas owners of treasuries to kind of swap their holdings for longer dated securities. It's a very big picture for markets to take in day on, day out. So these are things that I'm sure, portfolio managers are kind of thinking about and wondering, but until you actually see sort of real policy behind a Mar-a-Lago Accord, it's very hard to kind of make any decisions about what you actually own. And I think similarly with this kind of longer term picture around whether this could potentially be a positive for the US in the future, you kind of need to see that starting to play out. And at the moment, you just have a lot of kind of headwinds, like day in, day out, that you need to kind of be constantly repositioning for, or just stepping back and waiting to see the clarity kind of emerge.
Yeah, and Marcus, this is, I guess, the tricky part of it is that it keeps on coming up. Like, look, are we seeing the end of U.S. exceptionalism? What does it mean for stocks? Do you actually buy into European stocks? So you've been looking at, for example, EU versus U.S. performance of equities.
Yeah, and to be honest, for the last 15 years, US equities have been the only game in town. And rightly so. Over that period, the US market has outperformed Europe by over 300%. And European bulls have constantly been arguing that Europe is cheap and under-owned. But the problem is you need a catalyst for that re-rating to close. And that's what we've finally seen at the beginning of this year, which has led to the European outperformance. So on the one hand, you've got much more resilient European earnings, seeing actually earnings upgrades this year as a result of the slightly weaker euro. Of course, then you have the potential ceasefire in Ukraine, which would be supportive for the region from both a sentiment but also economic perspective. And then latterly, you've got the German fiscal stimulus, which has the potential to be a real game changer for the region. So we've seen a relatively big move year to date, but in the context of the last 15 years, it is still shallow. So we're hopeful that this could continue.
But is this a Draghi moment? I mean, when you look at the impact of the German fiscal stimulus, maybe raising productivity, also a lot of genuine efforts from European countries to reduce regulation. Could this be Europe's moment?
I think it could be. It's certainly a game changer for Germany, and probably to a lesser extent Europe more broadly. The sheer quantum of numbers is huge. Putin, it's important not to forget this. I mean, we're talking about 2.2% of GDP incremental spend per year on defence and infrastructure. And with the fiscal multiplier you typically see in terms of infrastructure construction spend, that has the potential to be quite powerful. But as you rightly said, it needs to be accompanied by broader productivity gains and hopefully less red tape to make Europe more competitive against other regions.
Rachel, I mean, the BOJ is also cutting the amount of super long bond purchases in the quarterly plan. Like, the BOJ is slightly apart from everything else. How would they be looking at tariffs?
Yeah, I mean, they're going to look to see whether they're going to be impacted by them. Of course, you know, there's this whole talk about, you know, the dirty 15 that Besant kind of referenced a couple of weeks ago, and are these going to be the ones that really get kind of hammered by tariffs? So Japan's going to be looking to see to what degree it kind of gets sort of, you know, labelled as one of these kind of trade abusers. But of course, they have their own sort of macro story to be dealing with. You know, the Bank of Japan is on this kind of path towards higher interest rates. That's not necessarily going to change unless you do see this kind of turmoil in global markets kind of take off to such a degree that for all central banks, they're having to think about lowering rates again to kind of support the economy. I mean, they've only just really started lifting off, so it seems unlikely that unless we really see ructions that's going to change.
Roz, I mean, in the middle of this, there's so much politics. And again, yesterday, you know, many people would have been taken by surprise by the fact that Vladimir Putin and President Donald Trump don't seem to be getting along like they used to.
Well, we are seeing a bit of frustration creep in, and publicly so, although Donald Trump then kind of sanded down his comments a bit later. He was talking initially about secondary tariffs, which seemed to be really secondary sanctions on Russian oil, and saying he was angry with Putin for positing out loud, it seems, that Ukraine could be replaced in terms of its government by a temporary administration from the UN. And the frustration here seems to be for Donald Trump is that getting a full ceasefire in Ukraine is going pretty slowly, and certainly slower than he would like. You've got a sort of partial ceasefire, you know, in the Black Sea, a partial energy ceasefire that's not really holding that well, but the real tough stuff on the ground is not even being discussed in great detail as yet. So we're some way off potentially for a full ceasefire. And any public comments, including even by Vladimir Putin, that might muddy the waters on that in terms of Ukraine would say, hang on, we're not going to rush here because are you suggesting that we need to replace our government? Is this something that Trump and Putin are agreeing on here? Anything that interferes with the process of speed for Donald Trump here, he's annoyed about, and that seems to be what's happened here. So it's not as though he says, you know, he trusts Putin, he knows Putin wants a deal, but equally he is expressing a little bit of frustration that maybe Putin is dragging the chain.
Yeah, I mean, after last week, this signal conversation on national security interests in the U.S., which the Republican Party are refuting that it was actually sensitive information. Are you expecting more on that? Will someone have to resign, or is it now bridge under the water?
Well, it's interesting seeing the reports that perhaps Mike Waltz, of course, could be the one who's in the line on this, although no signs that Donald Trump wants to fire anybody, because equally for him, firing someone so soon in his administration could be seen as a sign of weakness. Equally, he can't be happy that this is dominating the discourse, and what seems to annoy him above everything is that someone accidentally added a journalist to the chat. It's not that they were discussing confidential information in the chat about, you know, operational plans against the Houthis in Yemen. It's simply that fact, and perhaps a conversation that's going on still in the White House about that. We might see that there are efforts to move away from signal going forward, lessons learned there perhaps, but unlikely to go really beyond that. You can see the ranks that are closing, particularly again around others who were involved. For example, Hegseth, his defense secretary, seems to be in the clear.
Yeah, and on that, actually, the markets have, you know, overlooked any kind of, you know, an internal debate on what needs to happen. What's less clear is what happens to oil if there is a kind of ceasefire in Ukraine, Rachel.
Yeah, no, I think that's true, and I think, you know, I mean, to Roz's point about kind of the delay that they've seen in terms of like coming to a ceasefire. You know, Trump sort of said, you know, I'm going to sort this out on day one. You know, he came in with very sort of big plans, so people kind of had a sense of where things were trending. And whenever you see that, whenever people have a sense of where things are trending, the market tends to price it in. So I think there's kind of a question mark about like how much further things go when you actually see kind of a ceasefire agreed versus how much has already kind of been factored in. And certainly people are already thinking about how do you get investment back into Russia? How do you start getting, you know, Russia back into the community of acceptable security? So I think, yeah, it's TBD on kind of like exactly how much of that is still to go.
And Marcus, one of the big plays, of course, has been defense, European defense. Does that still have room to grow?
Yeah, I think so. You've clearly seen a big move in the European defence sector year to date, but actually really since the start of the Ukraine war, and valuations in the European defence sector have doubled over that time frame. So it's easy to feel that you might have missed the rally. But actually when you step back, and to quote one of the European defence CEOs, we have seen a clear paradigm shift in defence spending. And we'll see what comes out of the NATO summit in June. But I think it's clear that European defence budgets as a percent of GDP will start with a 3 and probably be in the mid-3s. And actually, when you realise that there'll be much greater focus on European procurement, you're probably looking at a 3 times multiplier on the procurement spend in Europe. The challenge for European defence companies is capacity utilisation is very high, if not completely full. And so it will take time for that not only to filter through to concrete orders, but actually for them to have the manufacturing capacity to be able to cope with these orders.
Okay, thank you all for joining us. A lot to get through on this Monday morning. Rosalind Matheson and Rachel Evans, thank you. And Marcus Morrison-Eaton from Alliance Bernstein stays with me. Now, coming up, a verdict due in the trial of Marine Le Pen over the alleged misuse of EU funds. We'll bring you the latest next. And this is Bloomberg.
Multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, Mondays on Bloomberg.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, is emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
In case you missed it, on Bloomberg Open Interest.
Finding some sense in these crazy markets.
I hope they turn around, though. You know, because my 401k, I'm looking at my 401, my retirement, and I'm thinking, God, how many more decades do I have to work?
Your retirement account. I cannot say that enough. Set it and
you need
forget
to find a new target date.
I need to find maybe a new future. I'll be standing next to Paul Sweeney as a greeter at Walmart, you know, in our 70s.
Don't miss Open Interest live weekdays.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week.
Welcome to Balance of Power.
This is Bloomberg Television.
The conversations that matter, the insights you need. This is a Pulse, and I'm Francine Lacqua here in London. Now, Marine Le Pen, the leader of France's National Rally Party, will find out today whether she'll be banned from running for president in 2027. An immediate ban sought by prosecutors is a very real risk for Le Pen if she and her party are found guilty of diverting millions of euros in EU funds to finance activities related to their domestic agenda. Well, Le Pen has denied the allegations. For more on this, we're joined by Caroline Conan from our Paris bureau. So, Caroline, we saw pictures, actually, of Marine Le Pen entering the court. So what do we expect from the judges today, and what could it mean for Le Pen?
We could actually have the verdict in the next few minutes or in the next 2 hours, because there are two different strategies for the judges here. Either they say the verdict first and then explain the reasons why, or the other way around. So it could be a little bit of a torture for the next couple of hours for Marine Le Pen, because as you mentioned, the biggest risk is that she could face an immediate ban from running for office for the next 5 years, which means she could potentially potentially be banned from running for the next presidential elections in 2027. Obviously, that would be a huge shocker for public opinion. She could also be found guilty but get a suspending sentence, which, of course, the National Rally hopes is going to be the verdict today. Marine Le Pen, along with 9 former members of the European Parliament, are accused of embezzling as much as 4.5 million euros of public funds from the European Parliament that they allegedly used for the operations of the party back in France, hiring, for example, allegedly fake parliamentary assistants who were in fact working for the National Rally back home and were not in Brussels and were not in Strasbourg. Of course, this verdict could potentially be a total game changer for 2027, the next presidential election.
So, Caroline, how popular is Le Pen right now, and who would be the backup plan if she becomes ineligible?
Francine, I want to show you this poll that was conducted by Le Journal du Dimanche, the weekend paper. 37%, that's how much you could potentially get in the first round if a presidential election was held today in France against the former Prime Minister, Edouard Philippe, or the former Prime Minister, Gabriel Attal. So that's more than 10 points more than the score she did in the first round last time in 2022. So obviously she's very popular. She's never been closer to possibly winning a presidential election. And a lot of analysts here are talking about a possible Trumpification of French politics, with the French people not necessarily understanding this decision, just like what we saw after the Capitol riots in the US, when Donald Trump was accused, obviously, of being responsible for this riot, and she could play the victim and gain even more popularity after this.
Caroline, thank you so much for the terrific briefing. Caroline Conan there in Paris. Now we're back with Marissa Eaton from AllianceBernstein, and we're joined by Bloomberg's Michael Msika, Deputy Team Leader for EMEA Equity Markets and Strategy. So thank you both for either sticking around or joining us. Michael, I mean, there's so much going on, right? There's a lot of political turmoil in Europe with Marine Le Pen, but also you don't really know what happens to the Bundestag once, for example, the German defense building is spent. Is April 2nd a kind of clearing event for European equities?
Well, Francine, that was the assumption until now. April 2nd, we're going to know everything. Stocks will price in everything that needs to be priced in, and then they can resume whatever they were going to do. That's not the case anymore. We've seen a big switch. People are getting more pessimistic. Now, April 2nd is more like another uncertain event. We've got hedging coming back to the forefront of anything, even though we had a lot of risk reduction in the past few weeks. There's still a lot of hedging going on. We've seen strategies cutting targets, especially in the US. So a lot of pessimism going on. Today, Goldman Sachs cut its target for the second time this month. On the S&P 500, there's just now pretty much no upside until the end of the year, over the next 12 months. In Europe, there's a bit more optimism still, but it remains really unlikely that the region will, hold their gains if the US starts really taking over.
And Marcus, I mean, this is a problem, right? You basically have a lot of political uncertainty. You could see voters very undecided in upcoming European elections. So you have tariffs, and then you have everything in between.
Yeah, exactly. And I think in many ways that is the ball point. In Europe, we're well used to political uncertainty. We've had our fair share over the last decade or so. And it feels like at the moment, as Michael rightly says, that we are approaching almost peak pessimism. I mean, everyone is rightly concerned about tariffs. But once we get a concrete understanding of what is announced and what is actually enacted, hopefully then the market can return back to focusing on fundamentals, which in Europe actually look quite healthy at the moment.
I mean, they look healthy, but then the million-dollar question is how healthy do they look for how long, Michael?
Yeah, that's the big problem. So in Europe, you have that stimulus package that is coming up. Obviously, there's a very big differential in terms of policy, whether it's fiscal or monetary. So Europe is like really positive, got lower rates. They're going to keep getting lower this year. They're going to be much lower than the Feds. The stimulus package is big. In the US, there's no stimulus that is planned at the moment. So there's all those positives. The problem is you've got all those tariffs and how big they become, and how much each country retaliates, and what's going to be the impact on global growth. And that's why you're seeing at the moment, the rotation that we're seeing is like everyone is getting out of cyclicals, and that shows that investors see those tariffs more as a global growth like impact, negative impact, rather than just like a sectoral kind of impact.
Thank you both, Michael and Marcus. Morris Easton there from Allianz Bernstein and Bloomberg's Michael Msika. Coming up, Donald Trump doubles down on tariffs ahead of a crucial week and issues a warning on Russia, so we'll have the latest. That's next, and this is Bloomberg.
What makes it India's time?
It's us women who are going to transform India. I truly feel that the time for Indian women has come. They're not only breaking glass ceilings, but they are redefining, whether it is in sport, whether it's in medicine, whether it's in creative arts. They are everywhere, and I have so much positive energy that comes back to me when I'm talking to Indian women. And I just think that all these little girls and boys, I don't want to discriminate, who are now in school-going age, imagine once education, sports, we empower them. What a difference they would make not only to India, but to the planet and the world. And the world needs it now than ever before.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 12 p.m. Eastern, right here on Bloomberg. Context changes everything.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. The global sell-off deepens as traders brace for more U.S. tariffs. Donald Trump rules out exemptions, saying all countries will be hit on April 2nd. The U.S. president also lashes out at Vladimir Putin, threatening secondary tariffs on buyers of Russian oil if he refuses a ceasefire with Ukraine. Plus, a verdict due in the trial of Marine Le Pen, the national rally leader, could be barred from running for French president in 2027 if found guilty. So global investors are bracing for the impact of President Trump's so-called reciprocal tariffs this week. On Saturday, Trump told NBC that he, quote, couldn't care less if automakers raised prices in response to the 25% levies on all imported vehicles and parts. Well, Bloomberg's global trade editor, Brendan Murray, joins us now from Copenhagen. So, Brendan, it's all over the place. What's the latest?
Yeah, so here we are just 2 days away from the big tariff rollout, and there still isn't much clarity on what exactly we're going to get. Late last week, we heard the president say he was going to be lenient in the doling out of these tariffs, but over the weekend, we heard him say that all countries are in the crosshairs. So what we're looking at are something on the order of 15 to 20 countries. Those countries make up about 80% of all U.S. imports, and if you're on that list, these could be anywhere from the European Union to Mexico to China to Vietnam to South Korea, Japan. These countries who've long had trade surpluses with the U.S. Are bracing for some of the highest of those tariffs, the exact level of which yet we don't know.
What's Trump's reasoning behind the auto tariffs?
He wants things made in the United States. That's ultimately the thing he wants most, particularly when it comes to automobiles. Automobile supply chains are spread out globally, particularly in Canada and Mexico, and he wants companies, whether they're in Germany or South Korea, to make those products in the U.S. Another incentive that they've been talking about in the tax bill is to provide tax incentives for Americans who buy cars made with all American parts. So they're linking the two, the fiscal issue together with the trade issue, and there's a lot of a range of things that we're going to get on Wednesday, from blanket tariffs on big trading partners to perhaps investigations that would lead to the legal authority to apply those tariffs further down the road.
Brendan, thank you so much. Brendan Murray there, who leads our global trade coverage. Now, President Trump has also threatened secondary tariffs on buyers of Russian oil if Vladimir Putin refuses a ceasefire with Ukraine. Well, Trump told NBC News that he was, quote, very angry at Putin for casting doubt on Ukrainian President Zelensky's legitimacy as a negotiating partner. Well, lots to discuss with Tina Fordham, founder of Fordham Global Foresight. Tina, thank you so much for joining us. I mean, first of all, just on these sanctions, when you look at, just away from geopolitics, there's a lot of tariffs. April 2nd is the big day coming. How are you briefing your clients on what that means economically?
Thank you, Francine. Well, first of all, tariffs are a form of geopolitical power. So just to get that straight, geopolitics is what countries do to project power across their borders. And so tariffs, sanctions are very much within that field. And they are far and away the most prominent instrument of economic statecraft. Our clients tend to be asking us to try to read President Trump's mind, and as you've already talked about earlier in the program, there are lots of pretexts being provided about what might be motivating these tariffs. The bottom line is, I don't think we're going to be very successful at reading Trump's mind. I think the uncertainty and the confusion is part of the MO, the modus operandi, and I think there's not enough attention being paid to retaliation prospects and what this means more broadly for the rules of the game and clarity around doing business.
Tina, when you look at some of the unorthodox, I guess, trade policies, is it too soon to find out how far the White House is willing to go?
I think if we're going to be diplomatic about it, that this is an iterative process, that there'll be an opening salvo and then attempts to negotiate. In our discussions with European member states trying to see how they're thinking about things, we are beginning to see evidence of holding back a bit for fear of potentially inflaming tensions further. And that makes it even harder for market participants to try to anticipate how to position, because it isn't likely to be the case that April 2nd, Liberation Day, we get some clarity, we can all sort of adjust and move on. The UK, for example, has been hoping for carve-outs. That is a double-edged sword. Italy as well, hoping that their better relationship, the relationship between Trump and Giorgia Meloni, might be helpful. I think market participants have kind of given up, and we can see this in this morning's sell-off.
Tina, overall, when you look at also some of the big news this weekend about, I guess, the U.S. and the UK saying we need to hold strong and maybe be tougher on Russia, how much do you understand the relationship to be between Vladimir Putin and Donald Trump at this point? Are they friends? Are they frenemies? Is it an economic advantage, or is it genuinely likability?
I think I've said on your show before that I expect Putin to run rings around Donald Trump, and with that in mind, the tough rhetoric about secondary sanctions, I think should be taken seriously. I think in general we should take President Trump seriously and literally. I don't believe that Putin is serious or has ever been serious about a ceasefire, and that may mean that President Trump gets increasingly frustrated with his erstwhile friend Vladimir Putin, because I don't think that Russia shows any real signs of wanting to come to the table. And frankly, it's also surprising to see President Trump annoyed about casting aspersions on Zelensky's legitimacy when we saw how he was treated in the Oval Office. And so, if anything, the pressure on Zelensky has actually bolstered his popularity at home and backfired in terms of what Putin would like to see, which is a different leader, one more pliable when it comes to what the Kremlin would like to see.
And Tina, where does the UK stand in all of this?
Caught in the middle, or putting a more positive spin on it, the UK really cherishes its role as a bridge between the European Union and Washington. But that bridge is looking a little bit wobbly, and it's a difficult position for Prime Minister Keir Starmer to take. But at the same time, he is, I think, rightfully receiving plaudits for his role. UK is convening a big meeting here in London today. And the question is really, to my mind, is whether the fact that Keir Starmer is a little bit of the teacher's pet when it comes to European leaders actually helps the UK, or ends up, potentially causing Starmer more problems than it helps.
Does that mean, Tina, that actually the UK is somewhat, if not exempt, in a favorable position ahead of April 2nd and the massive tariffs coming our way?
I think that's what the hope will be. But again, it's a real double-edged sword, potentially, and it has put Downing Street in the position of having to say that it would consider retaliation. And that's not something that I suspect the Prime Minister would have been wanting to make clear. But it's again, this need to constantly balance between wanting to be working constructively with Washington at the same time as Starmer has been pursuing a UK-EU reset and doesn't want to look to European partners like it's being singled out in a positive way for Washington. So very complex balancing act for the Prime Minister.
And Tina, where does this leave China? Again, there's a number of thinkers that say all of this changing geopolitics actually could push Europe closer towards China.
I think there's an opportunity for Europe at many levels. I mean, we have been talking in our research about the mega thesis, make Europe great again, not without many caveats, of course. The possibilities for China, I think, have actually increased as the U.S. has become more erratic in its global leadership. But let's remember, too, that the Chinese leadership is never really in a hurry. It can wait and watch on the sidelines, court potential deals and allies, and kind of do the cleanup when it comes to the potential for deals and for positioning.
Tina, as always, thank you so much for the great insight. Tina Fordham, they're founder of Fordham Global Foresight. Now, coming up, we'll speak to the chief executive of the European refiner, Varo Energy, about a deal that will make it Europe's second largest renewable fuel producer. That exclusive interview is next, and this is Bloomberg.
Technology news, geopolitical news,
economic news,
financial news,
bringing you the latest news in private markets
whenever,
and wherever it happens.
In Washington, Beijing,
Cape Town, South Africa,
Las Vegas,
Davos, Switzerland,
Rio de Janeiro, Brazil,
the south of France, and this
is Bloomberg.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything. It's Jobs Day, and Bloomberg has the report under surveillance.
This is another read on the U.S. labor market.
Workers are staying longer than you expected. How did firms actually deal with that new data point?
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
I do go back to what the lag time is between the soft data and the hard data. What's the lag data for the Doge effect?
That will speak to the anxiety in the labor market right now.
The March Jobs Report, Friday on Bloomberg.
The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, European refiner Varo Energy has agreed to buy Swedish biofuels producer Preem in a deal that will make it the region's second largest renewable fuel producer. Now, Varo is backed by trading giant Vitol Group and private equity firm Carlyle Group. Now, the deal comes as energy companies and traders look to diversify away from fossil fuels to greener alternatives. Well, I'm joined exclusively by Dev Sanyal, Chief Executive of Varo. So thank you so much, first of all, sir, for joining us, and congratulations. I know it's a big day for you, so we're grateful that you give us a little bit of your busy schedule. Why bet on renewables now when other industry leaders like Neste or Shell have pulled back or cautioned about the outlook?
Well, very good morning, Francine, and thank you very much for this opportunity to talk about what is, I think, an historic deal for us, and I think actually for European energy security. This deal is not just about renewables. I think at the heart of our strategy, it's about what we call the twin engine strategy. Engine one, which is about conventional energies that we want to make reliable, efficient, decarbonize it over time, and then over time repurpose it. And it's about selectively investing in what we call engine two, which is sustainable energies, primarily focused on molecules, biogas, biofuels. So this company combined will have revenues of $100 billion. It will have a very significant presence, over 500,000 barrels a day, in refining and manufacturing, but also have a very significant presence in biofuels in particular, as well as biogas. We will have 6 strategically positioned manufacturing hubs in both conventional energies as well as new energies, and we will serve 50,000 business customers in 33 countries through a network of 120 terminals infrastructure. So it's about both Engine 1 and Engine 2.
Okay. And do you expect renewable fuel margins to actually improve? And are you placing your bets more on sustainable aviation fuel or HVO diesel?
Well, I think we always take a view that the energy transition is all about being sure that we are flexible, not having a deterministic view. So as we think about, for example, sustainable aviation fuels, we can actually produce SAF, or we can also produce HVO in our units. Similarly, in biogas, we can produce biomethane, or we can produce bio-LNG. So I think the reality is that bio has a very strong momentum, because effectively when you think about the introduction of biofuels, you don't actually have to change the infrastructure entirely. You don't have to change the engines, and we are talking about essentially 80 to 90% reduction in terms of emissions. So it does provide a solution, not the only one, but a very important one as you think about decarbonization of industry as well as mobility.
Yeah. But are you prioritizing one or the other?
The point of an Engine 1 and Engine 2 strategy is we don't make a deterministic bet. We have a belief that the energy transition is going to be, very much energy additions. So we are clearly looking at making the conventional energies business a lot more efficient, decarbonizing it, while also investing in the renewable energies business, sustainable energies business. And the idea is that the energy transition won't become just one or the other. It'll actually move in parallel, and over time, you will see some technologies making more progress than others. But it is actually about making sure we can actually manage across the various forms of energies to create, if you will, optionality and flexibility for our customers.
Yeah. I mean, Prima has also pledged to cut crude usage, I think, about 15% by 2027, and then phase it out by 2035. Is that still realistic?
I think the way we sort of see it, that ultimately, customer demand and regulations will frame the pace of the transition. And, effectively, if customers are moving faster down a particular track, with our strategy, we are actually very able to adapt. And that's an agility that goes to the strategy rather than a deterministic target setting. We will do X or Y or Z. So, we shall see how the energy landscape evolves. It certainly has evolved in ways that were not completely forecast. That's ever been the case in my 3 decades in the industry. So facts will evolve, facts will change. And by having optionality, you can navigate the transition in a more effective way, which is about actually creating energy security as well as affordability alongside sustainability.
What's your read on diesel and jet fuel demand this year? If you look at refining or refinery margins, will they improve in 2025?
Well, if you forecast, you should forecast often. But what I will say is that refining margins are pretty robust right now. And I think it's fair to say that jet fuel is, growing in demand. And, that's a story of prosperity. It's a story of human progress. I think you will see undoubtedly that there will be other forms of transportation. EVs continue moving forward. But I think the full mix is going to evolve based on a number of factors, one of which is how do you actually ensure the appropriate growth dynamics in this business. Our business in energy is still growing, and you will see ups and downs, you'll see ebbs and flows. But, the prospect for refining is actually pretty robust at the current time. It'll go up and down as it always does. And I certainly think in the case of products like jet, you're seeing actually a story of progress and prosperity that actually mirrors the progress in the demand patterns for that product.
Do you expect overall margins to be better in 2025, or is it still a wait and see given tariffs and some of these trade wars with the U.S.?
I think, Francine, it is an element of wait and see. What I know for a fact is that whatever I say will be inaccurate. But I think the current prognosis looks encouraging in Europe. We've got an investment plan in Europe that I think will actually propel economic activity. As I think about some of the micro factors, they're actually quite encouraging. When you go to the industrial heartland, in Germany, Varo produces 30% of the energy in that area. we are seeing, progress. But there's more to be done. But I certainly think the narrative has shifted in the last 1 month. There is more optimism, more confidence because of the investment program, because of defense security, which I think goes hand in glove with energy security. And so the prospects are encouraging, but it'll not be a straight line as always. And I don't think that's just true of conventional energies or renewable energies. It's true of energy as a whole, the entire system.
Thank you so much for joining us. That was Jeff Sanyal there, the Varo chief executive, with a big deal on his hands, actually, that was announced just a couple of hours ago. Now, we're just getting some breaking news out of France now. This is a big one. Look, France's Marine Le Pen has been found guilty in the case over misuse of EU funds. Again, a warning that there could be, first of all, some time between this and the sentencing. And so this is happening in a court in Paris. This is, of course, Marine Le Pen, the leader of the National Rally Party. She's about to find out whether she will be banned or not from running for president in 2027 due to an embezzlement case. We don't know whether that changes her political career or her political fortune. The only thing we know for the moment is that France's Marine Le Pen has been found guilty in case over misuse of EU funds, but now we're expecting the sentencing from the judge, which would give us an indication of what happens to her political future. As soon as we get that, of course, we'll bring you the very latest. Now, in a moment, we'll talk banks with Bloomberg's Charlie Wells, but first, today's big take looks at the rising concern in the foreign exchange market about a potential system-wide crisis due to a liquidity mirage. Well, this, as a proliferation of trading platforms and automation, has created a fragmented market. So let's get more on all of this with Bloomberg's FX and rates reporter, Alice Atkins. Alice, so good to speak to you. Wonderful, wonderful reporting with the big takeout today. Why are people worried about FX liquidity?
Now, FX is the largest financial market in the world, but it's also probably the most complicated. There's no one central exchange, and trading activity is scattered across dozens of different platforms and venues. Now, on a day-to-day basis, liquidity is fine. Electronic trading has dramatically slashed the cost of trading, and it's increased the speed with which things turn over. But during more stressed market conditions, players like XTX and Citi are saying that liquidity is becoming increasingly fragile, and this is for a number of reasons. It's partly because banks are less able to warehouse risk now. They've also moved to internalize a lot more flow, so the primary markets are significantly less liquid. And this is stacked up to create an environment where, when you get very directional markets, like with the yen carry blow up last year, small trades can end up causing oversized moves.
So, Alice, has this caught the attention of regulators?
So FX isn't as regulated as other asset classes, and that's because it stretches across different time zones and jurisdictions, but it is closely monitored by the central banks in each nation, and they put together a set of best practice principles known as the FX Global Code, and liquidity is part of that set of principles, and lots of them are sort of upping how closely they monitor the market against this backdrop of liquidity challenges. The New York Fed hosted its first conference on FX market structure just a few months ago, and they talked about how the appearance of liquidity in these abrupt pullbacks is becoming more frequent, and they're closely tracking the growing role of non-bank market makers in keeping liquidity flowing. The Bank of England has also warned and been pushing for more transparency in the market for some time.
And so how are asset managers dealing with all of this?
It's certainly a challenge for asset managers, and what's become very clear is that it's still a relationship-driven market, even if lots of things happen electronically. Some of the older trading platforms can struggle to keep up with price updates during volatility, and so lots of asset managers are trying to narrow down their liquidity providers, fine-tune the trading platforms that they're using, and amid all the volatility we've had around Trump's tariff headlines, some have even reverted to voice trading. So old-school voice trading still plays a big role in the market, even though it's largely electronic.
Alice, thank you so much for the terrific briefing, and of course, congratulations on the story. You can find Bloomberg's Big Take on all of our platforms, Bloomberg's FX and rates reporter, Alice Atkins. Now, with one trading session left in the quarter, U.S. bank stocks are on track to end their worst 3 months since the 2023 regional banking crisis. It's a different picture for the European counterparts, who are ending their best quarter since 2020. So here to talk about the transatlantic divergence is our very own Charlie Wells. Charlie, thank you for joining us. So what explains the split between U.S. and European bank stocks this year? here?
Francine, I mean, if you're going to pick one theme that just screams out when you look at these charts, it's that political kind of influencing banking here. And we're seeing these political differences on either side of the Atlantic, where you've got this huge amount of cash, this huge push towards defensive spending in Germany, this huge push towards infrastructure, really boosting this banking sector that's already been boosted by cross-border M&A and also by buybacks. Look at the U.S., you've got that picture of uncertainty that really kind of came in about halfway through the quarter and just saw bank stocks. I'm thinking about the KBW Bank Index that captures a lot of these big banks just careening down on fears about uncertainty, on fears about that M&A pipeline.
And so what are we expecting for earnings? Are we going to see even more of a divide?
This is interesting. So in the U.S. in particular, we've seen these share prices go down, but analysts have kept their earnings estimates roughly where they were at the beginning of the quarter, so not a huge drop there. But I think the razor focus is going to be on M&A activity because that is such a big driver of revenue for these banks. And there had been such high hopes going into this quarter that we'd see that, but it really is in wait-and-see mode.
Okay, Charlie, thank you so much. Charlie Wells there with the very latest on this divide between European and U.S. banks. Now, in the last couple of minutes, we also had basically this Paris court ruling on Marine Le Pen. Again, the French judges have not yet read out the sentences in Marine Le Pen, but what we know is that she's been found guilty in the case over misuse of EU funds. Now, prosecutors are seeking an immediate ban and a 5-year electoral ban for Le Pen, who's denied any wrongdoing and claims that the prosecution is seeking her political death. We don't yet know what happens actually to her political career. We'll bring you that sentence as soon as it's issued. Now, the Republican Senator Ted Cruz, a little bit later on balance of power. Don't miss that conversation, 9:30 p.m. London time. Up next, Bloomberg Brief, and this is Bloomberg.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turned a profit.
Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays at 9 p.m. Eastern Time, right here on Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Good morning from our global headquarters in New York. I'm Katie Greifeld. Danny Berger is off this week. Welcome to Bloomberg Brief. Let's set your agenda. Tariff risks fuel a dash to havens. The S&P 500 sees its worst quarter since 2022. That's as President Trump says he plans to start his push for reciprocal duties with, quote, all countries, and threatens secondary tariffs on buyers of Russian oil if President Putin refuses a ceasefire with Ukraine. All that and more coming up. Let's take a look at how these markets are trading in these pre-dawn hours in the U.S. You can see the S&P 500 looking to end the quarter on another down note, down about 0.9% in the pre-market trade. You can see the losses really coming from big tech right now. The NASDAQ 100 down even more, about 1.3%. Big tech has been the stumbling block for this market in the first quarter, and that is certainly the case, at least if you take a look at the action right now. And the small caps also feeling the pain. The Russell 2000 off about 1.2% right now. That is your equities picture. If you take a look at bonds right now, of course, it's been a really interesting quarter, and you can see that rally is continuing right now, pushing the 10-year Treasury yield below 420, down another 5-6 basis points, and that bid holds across the curve right now. A lot of the buying action coming in the short end, but certainly it seems like the bid is continuing across the curve right now. Meanwhile, back to the equity story, we're also keeping an eye on Tesla. Elon Musk says that leading Doge for the Trump administration is costing him, quote, a lot. As CEO of the company, shares rose to a record high in the month after Trump was elected, but have dropped 45% since their peak in December. Next up, we have Wolfspeed extending its decline after suffering a record one-day loss. The chip company is struggling to reach a deal to refinance its convertible bonds due next year. Had a terrible end to last week, rising a little bit right now, up about 1.2%. And finally, Oracle, following reports that hackers broke into the computer's system and stole patient data, down about 1.8%. This was reportedly an attempt to extort multiple medical providers in the U.S., according to sources. In just a few moments, we'll speak to Mads Peterson of Human Edge Investment Technology, and then later this hour, we'll be talking to Skylar Montgomery Koning of Barclays. So a lot coming up right now. Let's keep this conversation going with Mads Peterson. He is the CIO of Human Edge Investment Technology, joining us right now. Great to have you with us to kick off the week. You think about Liberation Day coming up in the next 2 days. There's a lot of uncertainty whether or not we actually will get some clarity, perhaps some relief, or some broad escalation of the trade tensions that are also already percolating around the globe. Where do you sit right now in your positioning as we count down?
Yes, so we reduced our risk when the noise went up on the administration. I think it's not too controversial to say that everyone was expecting quite a lot of uncertainty, and we got more, so we reduced early. February, we sold 40% equities from 100 to 60, and now we're waiting for clarity. I'm afraid what we get Wednesday currently looks like we both get more tariffs, and we get also more probably conflict. If we get clarity, it can be the building blocks for re-engaging with equities. But first, we need to digest what's coming out today, what came out Thursday and Friday. And markets need to recalibrate the situation. But I think the underlying situation is good, but there is too much noise and too much uncertainty at the moment to really get positive again in the short term.
Well, let's meditate on your allocations a little bit more right now, because you mentioned you reduced your equity holdings from 100% to 60% in the beginning of February. You boosted your bond allocation. That's got to feel pretty good right now, considering that this was the first 3-month period since 2020 that bonds actually outperform stocks. Do you think that that is the setup going forward? And as such, if so, would you actually boost that bond allocation at the expense of stocks even more?
In an ideal world, and we're not that far from a good world in the sense that what we saw Friday was that even though PCE inflation moved up, bonds were actually performing well. In a world where there is clarity, in a world where there is clearness from the central banks, we would not increase the weight in bonds, but we would increase the duration. Now, what we need is clarity. And therefore, I think the risk-return trade-off for the next 3 years is still better in equities than in bonds. They are behaving okay. The real big question and what Trump has to be really careful with is not to break the positive situation where you have a situation where when you have risk-off in equities, bonds perform. So he needs to not do more tariffs than that he doesn't create more than a temporary inflation. The real risk is, remember, tariffs is a tax, okay? And it's a tax on the consumer in the end. You can call it what you want. You can call it Liberty Day or Liberation Day, but it's still a tax on consumers. That's also not in the Republican interest. So they need to be a little bit more careful than they've been the last week. Hopefully it was shock and awe, and then calm and consideration after.
It's interesting to hear that you would be looking to step out into duration here, further out the curve, because we've seen a lot of folks just hanging out in cash. That is still one of the hot trades. And I'm curious, Mads, you saw an interesting dynamic on Friday. You had this very, very rocky University of Michigan sentiment data where the sentiment headline number went down, but also long-term inflation expectations rose to a 32-year high in the U.S. At the same time, you saw long-end yields actually drop, catch a bid on the heels of that. What does that tell you in terms of how investors are balancing inflation fears over growth concerns?
Well, it tells me, first of all, that investors care less about egg prices than consumers. and the important part here is, as the U.S. economy becomes more and more uneven, and we have seen the Democrats make the U.S. economy extremely uneven by pushing up house prices and inflation, well, then actually the consumer sentiment matters less, and what matters more is what the 20% top or the 40% do, not what the average consumer do. That's what the market is saying. The market is saying, okay, we might even get a little recession here, but when the five-year moves down, we're saying, we're probably going to get rid of the inflation. And that's the balance we need. Now, cash is historically attractive. You know, you can get 3-4% in a money market fund in the U.S., which you haven't been able to do for much of the last 20 years. So that's why people stay there, and that's why it makes sense for cautious investors to stay there. But what Trump needs to make sure is that we don't get the inflation boost which we got when Janet Yellen and Powell overstimulated the economy. They said they want to run it hot, and they ran it way too hot. Trump is running the economy, pushing it a bit hot now, and he needs to be very careful not to offset, not to move the inflation expectations from the Michigan survey into the bond market. That's what they need to manage. And that's until now looking okay, but that's the place where we see if the balancing act is in place or if things fall out into chaos.
And certainly a difficult set of cards for the Fed to deal with as well. Mads, before I let you go, I do want to talk about what's going on in Europe. Something amazing happened this quarter, and that was that the Stoxx 600 outpaced the S&P 500 by nearly 17 percentage points in dollars terms. That would be a record outperformance. There's still a lot of skepticism around that European equity outperformance. I wonder where you fall in the debate.
I fall on the debate that we've been underweight for 10 years across two different institutions. I was underweight when I was working at UBS. I've been underweight with my own company here in European equities. And the typical outperformance you see in first and second quarter typically falls out. What we're considering now is it time to go neutral? Because what we have seen in German politics is positive. But what you see in the European market is interesting, yeah? SAP trades at double the PE of Microsoft. That's not cheap. But you have the car manufacturers, which trade Mercedes, BMW, Volkswagen. They trade between 4 and 7. That basically means the market is saying there's a decent chance these companies go bankrupt. And most of the Germans I talk to, they're not aware that the two largest shareholders in Mercedes are Chinese. So when China is done with emptying the intellectual property out of the German car manufacturers, it's going to be interesting to see if they can rebuild. Well, if they don't rebuild, so we have a positive start, if we should sum it up, a positive start, a very positive development in German politics. If the Europeans now step in, it will be good. If what we heard before the news about Le Pen, if J.D. Vance tries to take a swipe at the French in this situation, then we can have a very negative situation. So the next weeks and then the years will be Europe has to follow up on what happened in Germany the last 2 weeks.
All right, certainly a lot of cross currents to keep track of. Mads, great to speak with you on this Monday. That is Mads Peterson of Human Edge Investment Technology. Now to other top stories trending on the terminal this morning. Japan's tech-heavy Nikkei 225 stock average enters a technical correction. Stocks linked to exports or semiconductors have dragged the index due to global trade concerns. The gauge has fallen 11% this quarter alone. Meanwhile, a member of the pop band ABBA and EQT founder Connie Johnson have raised over $1 billion for a music fund. About 30% of the fund's capital is already deployed in catalogs of established artists such as Kiss and Cyndi Lauper. And Aston Martin is looking to raise at least $160 million by selling more shares. Canadian billionaire Lawrence Stroll's U-Tree consortium is paying nearly $70 million to increase its stake in the struggling British car maker to around 33%. The company also aims to sell its minority stake in the Aston Martin F1 team. Now, coming up, markets brace for President Trump's tariff announcement on Wednesday. We'll discuss his latest comments next. This is Bloomberg.
The top names in business are on Bloomberg.
Over the last couple of months, we are redrawing geopolitical lines. At the same time, we have tariffs. We are trying to reinvent the federal government geopolitically as well as economically in the middle of a transition, looking to change everything. And as a result of that, the uncertainty is maddening.
Nobody covers business like Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, is emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
It's Jobs Day, and Bloomberg has the report under surveillance.
This is another read on the U.S. labor market.
Workers are staying longer than you expected. How do firms actually deal with that new data point?
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
I do go back to what the lag time is between the soft data and the hard data. What's the lag data for the Doge effect?
That will speak to the anxiety of the labor market right now.
The March Jobs Report, Friday on Bloomberg.
I don't think he's going to go back in this world. I've known him for a long time. We've always gotten along well. He considers Zelensky not credible. We're supposed to be making a deal with him, whether you like him or you don't like him. So I wasn't happy with that. But I think he's going to be good. And I certainly wouldn't want to put secondary tariffs on Russia, but if they were put on, it would not be very good for them.
And that was President Trump speaking on Sunday, threatening fresh penalties on Russian oil if Vladimir Putin refuses a ceasefire with Ukraine. For more on the president's latest tariff remarks, Bloomberg's Ben Sills joins us now. Ben, give us the lay of the land. What would secondary tariffs on buyers of Russian oil look like in practice?
Well, I think it's probably going to have to seek to clamp down on this shadow fleet that has been really kind of deeply involved in keeping the Russian oil trade going. the fundamental objective there is to drive down the price that the Kremlin gets for its oil exports, and in that way to try and bring some serious financial pressure to bear on Putin.
And it wasn't just Putin. I mean, Trump also had some words for Ukrainian President Zelensky, saying that there's going to be big problems if Zelensky backs out of that rare earths deal. It's worth pointing out that a lot of this comes down to rare earths when you consider the relationship with Ukraine.
Yeah, I mean, that is a comment which slightly misrepresents the state of negotiations. The Ukrainians have not signed up to that deal yet. We had details of the latest proposal from the US last week, which would mean handing over widespread control over both who gets to invest and who gets the money from Ukraine's, not just from Ukraine's minerals reserves, but also investment in infrastructure as well as the country looks towards rebuilding. It's very difficult for the Ukrainians to sign up to that sort of kind of widespread deal with the US, but at the same time, they do need to try and keep Trump on board, and we've seen how easily that can go off the rails in the last few weeks.
Yeah, and appreciate you setting the record straight. There's been no deal signed yet, but let's focus a little bit more specifically on the U.S. because White House Senior Counselor for Trade and Manufacturing, Peter Navarro, was on Fox News speaking about the potential Trump tariffs and the impact it'll have on America. Let's take a listen.
Let's work through the economics of this. First of all, we're going to raise about $100 billion with the auto tariffs alone. The other tariffs are going to raise about $600 billion a year, about $6 trillion over a 10-year period. And we're going to have tax cuts. It's the biggest tax cut in American history.
And Ben, interesting to hear him frame the tariffs as a tax cut. We just heard from Mads Peterson a few minutes ago and a number of economists saying that no, tariffs are actually a tax, raising taxes on the American consumer.
Yeah, 100%. I mean, the rationale that the Trump administration is offering for this policy completely flies in the face of all conventional economic analysis. Time will tell who is right, but the economics profession is very clear about what the impact's going to be.
Yeah, it's rare to see such consensus among economists. Ben, great to speak with you this morning. That is Bloomberg's Ben Sills. Meanwhile, let's take a check on these markets as we count down to that April 2nd Liberation Day, as the Trump administration is calling it. You can see the S&P 500 down almost 1%. We got there in the last few minutes. That was a session low for S&P 500 futures. You can see that the dollar not exactly catching a haven bid right now, down slightly. But if you're looking for a haven, you're finding it in the bond market. 10-year Treasury yields down. If you round up to about 6 basis points, that takes us below 420 on your 10-year Treasury yield. Now, coming up, we'll take a look at what else is making headlines around the world, including the verdict that may rock France. This is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
What's the hardest part of being a CFO?
It's hard to come up with that.
It's the vast responsibilities, the need to be engaged in different topics.
It's remembering which audience I'm speaking to and what I can say in that context.
The job is not just being the executive of the finance function, it's being an executive for the company.
I would say it's prioritization.
Complete the sentence. The hardest part of being the CFO is?
Telling people no. It's hard. It's the right thing to do, but it's always hard.
So being just like a touch of a heartbreaker, basically.
Yeah.
We have a plethora of good opportunities. Some are really, really good. But as we strive for the great ones, sometimes those really, really good ones have to be left behind.
New episode premieres April 23rd, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
In case you missed it, on Bloomberg Technology.
This is the first event in history where a company CEO invites all of the guests to explain why he was wrong.
We have a vision about how quantum computing will be useful.
We're still at the beginning of a learning curve with respect to how NVIDIA and Jensen interact with quantum computing companies.
Don't miss Bloomberg Technology live every weekday.
This is Bloomberg Brief. I'm Katie Greifeld in New York. It's time now for our front page news, a look at what's making headlines around the world. And first up, on the New York Times, freezing rain knocked out power for over 900,000 people in Indiana, Michigan, Wisconsin, and Ontario. The storm downed trees and snapped power lines. Next up, on the Wall Street Journal, Apple and Elon Musk are clashing over the company's push to eliminate cell phone dead spots with satellite technology. The iPhone maker is investing heavily in satellite-based comms and competes with the Starlink and SpaceX CEO for rights to the airwaves to carry their signals. And on Bloomberg, in France, Marine Le Pen, Emmanuel Macron's main political rival, has received a guilty verdict in court that may ban her from running for president in 2027. We've just got news that she's been found guilty. We're awaiting the judge's decision on the punishment. Joining us now with the latest is Caroline Conon. And Caroline, we've gotten the guilty verdict. What's next?
That's right. She's been found guilty of embezzling public funds, as much as 4.1 million euros of European public funds, according to the ruling. This is in the trial, basically, where she's been accused, along with 8 other members of the European Parliament, of using fake assistants hired for the European Parliament in Brussels and in Strasbourg, who were in fact working for the National Rally back here in France. We don't have the details yet on exactly the sentence. The judges are reading out the ruling as we speak. We could have more details over the next few minutes. There are 3 possible scenarios right now. An outright ban of Marine Le Pen running for office. That ban could last 1 year, 18 months. In that case, she could still run for the next presidential elections in 2027, or she could get perhaps a suspended sentence. In that case, she could appeal the verdict. And of course, the worst case scenario for her is that she gets an outright ban for 5 years, meaning she cannot make it for the next presidential elections in 2027, when she is a clear favorite.
And just to repeat this news, it's far-right leader Marine Le Pen. She has been convicted of embezzlement by a Paris court. But Caroline, as you point out, the judges haven't yet said if she will be banned and stopped from running to be France's next president. Give us some context here. How popular is Le Pen right now? And what would be the backup plan if she does become ineligible?
She's extremely popular. Let me tell you, she's never been closer to winning possibly this next presidential elections. Let me show you this poll. Even if you can't read French, you can see the number 37%. That's what she would get in the first round of the French presidential elections if this election happened today. Even if she faced the former Prime Minister Edouard Philippe or the former Prime Minister Gabriel Attal, it doesn't matter. She would get more than 35% of the votes in the first round, which would be more than 10 points what she did back in 2022. As you know, Emmanuel Macron cannot run again. He's already done 2 mandates, so she is clearly one of the key contender, and it would be a shock in public opinion if she cannot run, even for those who don't necessarily want to vote for her. Even the former Interior Minister Gérald Darmanin, at the time of the prosecutor's requirement back in November 2024 after the trial, said that Marine Le Pen needs to be fought in the ballot box, not in court. At the time, she accused the prosecutors of a witch hunt, interfering with the democratic process. And over the weekend, she gave another interview to a French paper saying that she was not necessarily nervous about this verdict today because she could not believe, she could not even imagine that the judges would actually sign her political death and prevent her from running in 2027.
All right, Caroline, appreciate your instant reaction there. That is Bloomberg's Caroline Conon, of course, bringing us the news and the context around this headline that France's Marine Le Pen found guilty in case over misuse of EU funds. We'll continue to track that story. And up next, we're going to take a look at moves in FX markets with Skylar Montgomery-Koning of Barclays. That conversation up next. This is Bloomberg.
Prided myself, probably wrongly, having worked in many countries, been brought up as a child in the Middle East and in the Far East, having a mother who was not British, she was Hungarian, she was a survivor from Auschwitz, and I was the son of a Holocaust survivor, and being involved with lots of people, I thought to myself, I know a lot about diversity. And I know about inclusion and not being included. But actually, when I came out, I realized that my level of understanding was not very high. And actually, I could see both the support and the rejection of being different, and what you had to do to live a life where you were different. And I'm immensely pleased that I was outed when I was 60, just under 60. Because had I not been outed, I probably would have said I could stay in the closet and still believe that I knew everything, which I didn't. And that was a very important moment for me.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, Mondays on Bloomberg.
our global headquarters in New York, welcome to Bloomberg Brief. I'm Katie Greifeld. Let's set your agenda. Tariff risks fuel a dash to havens. The S&P 500 sees its worst quarter since 2022. That's as President Trump says he plans to start his push for reciprocal duties with all countries and threatens secondary tariffs on buyers of Russian oil if President Putin refuses a ceasefire with Ukraine. Let's take a look at these markets right now. The S&P 500 down mightily in the pre-market. Not quite at session lows, but still down about 0.9%. As I said, it has been an ugly, ugly quarter for U.S. equities. And a lot of that pain has come from big tech. The Magnificent Seven turning into the Lag Seven. The NASDAQ 100 down about 1.2% as we count down to the opening bell right now. And small caps also haven't escaped the pain. The Russell 2000 down another 1% in the pre-market. Let's take a look at the bond market as well, because that's really where your haven has been this quarter. Bonds hadn't been working for a while, but things really turned around in the first quarter of 2025, and that continues today with yields really falling across the curve. The 10-year Treasury yield down about 5 basis points. We are just below 420, but it's the short end that's taking most of the buying energy right now as people really question what this Federal Reserve is going to do. Let's try to put this all together and talk about the implications for the currency markets with Skylar Montgomery Koenig. She is an FX strategist over at Barclays, joining me in studio at 5:30 in the morning. Great to see you, Skylar.
Thanks for having me.
So let's talk about these currency markets, because as we try to keep track of all the different tariff headlines, the will he, won't he, and the back and forth, it feels like a lot of that volatility is playing out specifically in currency markets as the first order effect. Do you think that that is going to be the dynamic going forward as we get deeper and deeper into the trade policies of the Trump administration?
Well, this is the really hard part, is we've had so many tariff headlines already, and we're however many months into the presidency. And with Canada and Mexico specifically, you've had so many headlines around tariffs coming in and then being pulled back, and these back and forth headlines mean that it's harder for the market to price in anything definitively, and it's also harder for corporates to react, because what are they reacting to policy-wise, especially autos, for example, with auto tariffs and USMCA compliant and non-compliant, and so there's a higher bar for the market to react now, and I think the real test of that will be this April 2nd deadline, as in, will we get tariffs, will they be implemented in large scale, and will they be sustained? And I kind of worry that even if we get tariffs, it might take it feeding into the hard data elsewhere, or for them to be sustained for markets to really price them sufficiently, especially in FX.
It's a good point that April 2nd will likely bring more questions than answers when you think about potential exemptions, whether or not we'll see further escalation. So watch that space. I want to talk about the role of the dollar in all of this, because I take a look at the Bloomberg Dollar Index, down almost 3% for the quarter. Really hasn't caught any of that haven bid, that haven energy that's been going into the bond market, into U.S. Treasuries. What do you make of that disconnect?
I think there's U.S. growth worries that have come to the forefront, and that's shown in economic surprises turning down, and it's both a narrative shift in terms of growth consensus for 2025 went up pretty phenomenally or quite significantly after Trump was elected, and so that's a higher bar to beat in terms of consensus expectations, so it's easier to get negative economic surprises, and we have truly gotten some more negative policies as well, and so that's showing up in the dollar, but I think it's not showing up elsewhere in terms of, if the U.S. slows down, that's bad for global growth, and on average the dollar tends to gain during U.S. slowdown periods, and so you need it reflected elsewhere, or maybe we've just gone too far in pricing a U.S. slowdown.
Yeah, you make two important points there. The first being that the dollar is coming off of a very high base. The dollar rallied about 7% in the last quarter of 2024, so taking back some of that. And then you make the point about the state of global growth should the U.S. slow down. And you see all of this enthusiasm in the euro, as well as European equities. The euro against the dollar gained nearly 5% if you round up in this past quarter. There's been a lot of skepticism over the performance of European equities going forward. It sounds like you're echoing that skepticism when it comes to the euro currency.
Yeah, I mean, fiscal is certainly a positive for Europe. It's definitely a game changer with respect to Germany as well. But you're going to get a max of 2.5% of German GDP, not even European GDP. We don't see that feeding into growth until 2026. And if you have a tariff rate above 5% on Europe, that more than negates the positives for growth that you get from fiscal. And the fiscal very much looks priced in, especially in Eurodollar. And I don't think it undoes the last decade that we've had of U.S. exceptionalism that's been boosted by the fact that you've got more fiscal in the U.S. versus Europe, and means that you have a higher neutral rate naturally in the U.S. versus Europe.
Interesting. And I also want to talk about the yen because we talk about FX volatility. You really only need to look to the yen over the past year or so. What profile has the yen taken on in the first few months of the Trump administration? Has it regained its safe haven status?
I think absolutely. And so we've made that change with the yen in terms of we also like buying the yen for good reason. It's both domestic as well as international. So internationally, as you say, it's a safe haven status, really makes it attractive, but also Japan is less susceptible to tariffs, both from a deficit perspective in terms of the U.S. having a deficit with them not being as much of an issue, as well as them being willing to negotiate. And then domestically as well, the outlook's quite positive. They're hiking, and we think they're going to hike to a terminal rate of 1.25%, while the rest of developed markets are easing. And so that means that you're not as negative from a carry perspective on the yen.
So Japan's sort of swimming against the tide there, and the yen has gotten its groove back, at least when it comes to being a haven. I am curious to get your perspective, Skylar, as we count down to April 2nd, and, you know, TBD what's going to happen there. What is the currency pair or the couple of currency pairs that you're going to have on your screen that you're going to be keeping an eye on as we start to get some of these headlines and maybe some clarity?
So I think with tariffs, there's a clear bias to target the economies that the U.S. has a deficit with. And so that's China, Mexico, Canada, and Europe. And I think those will be the clear targets, but that's not only the country we've expect to be tariff when it comes to that April 2nd deadline. I think there was this view that maybe it was a narrowing, that we weren't going to get tariffs across the board on however many countries there are in the world. But the USTR report that's investigating what countries to tariff has something like 20 to 25 countries listed. So yes, 20 countries is less than what the entire world is in terms of countries, but that's still a lot of countries, and it represents around 90% of U.S. trade. And so for us, it means that, you know, you need to be watching these currencies that have the largest deficits, because those are likely targeted. But you also need to think about broadly what the reaction will be within cyclical currencies versus safe haven currencies. It will probably be bad for the risk backdrop, and that will feed throughout markets.
So put it all together, you're going to be a busy woman. Really appreciate you taking the time on this Monday morning. That is Skylar Montgomery-Koning of Barclays. And coming up, markets bracing for Donald Trump's tariff announcement on Wednesday. We'll discuss his latest remarks next. This is Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, Tuesdays only on Bloomberg.
What is the issue between the type of information that's being collected by investors and the marking issue that you're describing?
But what mark-to-market assets do is it forces honesty into the situation. We're talking right after the DeepSeek model surprised everybody in its efficiency. It took hundreds of billions off of market caps because it legitimately raised concerns that maybe the future of AI was different. I guarantee you that if you look at other portfolios that aren't marked, they didn't move. If private assets are going to eat the world, as they say, with the equity market halving in the number of names, you come to a world that is increasingly an echo chamber. Imagine you have a firm that has some public assets and some private assets. If you see your public assets in AI going down by 20%, you're going to be thinking very, very deeply about what your private assets are worth differently than someone who just has the latter.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
You're talking about Putin. I don't think he's going to go back in this world. I've known him for a long time. We've always gotten along well. He considers Zelensky not credible. He's supposed to be making a deal with him, whether you like him or you don't like him. So I wasn't happy with that. But I think he's going to be good. And I certainly wouldn't want to put secondary tariffs on Russia, but if they were put on, it would not be very good for them.
And that was President Trump speaking on Sunday, threatening fresh penalties on Russian oil if Vladimir Putin refuses a ceasefire with Ukraine. For more on the president's latest tariff remarks, we're joined now by Bloomberg's Rosalind Matheson. So, Roz, you heard Trump there talking up his relationship with Putin. What do we know about the latest state of play when it comes to that potential ceasefire?
Well, that's right. So we saw some frustration start to spill out a bit in the open on the weekend from Donald Trump over the Russian president. And that seems to be really a sense that, Donald Trump came into office promising that he'd get Ukraine's ceasefire very quickly, on day one even, or by Easter. And the reality is it's going a lot slower than that. We only have partial ceasefires in place in a couple of areas, nothing really on the ground in the conflict itself, in a sense that maybe Vladimir Putin is dragging the chain on that, and a sense of frustration coming in. And so you saw him lash out a little bit at Vladimir Putin, although he also walked those comments back a bit later, saying he didn't plan to put secondary sanctions for now, at least on Russian oil. But the idea is that perhaps he's growing frustrated again at the pace of the progress towards a full ceasefire.
Yeah, that negotiation still fluid right now in stages. But let's talk about secondary tariffs. Also on Iran, President Trump threatening that as well. Talk us through the potential impact here that would have on the oil market.
Well, it's interesting to see Donald Trump talk about secondary tariffs, which really are secondary sanctions, it seems, and that's people who are buying these things from other countries. So, for example, buying Russian oil, a lot of that goes to China and to India, and for Iran also, exporting some oil at least around the world, because the Biden administration loosened the reins a bit on that. And so very important for Iran to be pumping oil out to the world for its economy, because we know the only thing really sustaining the Iranian economy is oil, primarily, and supplies from other countries as well. And so if you put secondary sanctions on Iranian oil, or on Russian oil for that matter, it can really have an impact on the oil market. I mean, the demand for oil has been on the low side, so you would get an impact on Russia and Iran specifically, and all of that seems to be from Donald Trump about squeezing Iran, potentially trying to pressure Iran to come back to the table, because so far Iran is saying it's willing to talk, but not doing it under duress.
Well, crude prices moving just a little bit higher right now, as you mentioned, sort of constrained by that weak demand. But let's talk a little bit more directly about the U.S., because we had White House Senior Counselor for Trade and Manufacturing, Peter Navarro, on Fox News, speaking about the potential Trump tariffs and the impact they'll have on America. Let's take a listen.
Let's work through the economics of this. First of all, we're going to raise about $100 billion with the auto tariffs alone. The other tariffs are going to raise about $600 billion a year, about $6 trillion over a 10-year period. And we're going to have tax cuts. It's the biggest tax cut in American history.
It's interesting to hear basically Navarro connect tariffs with tax cuts. Economists would disagree with that, but that seems to be the messaging that the Trump administration is taking, Ross.
Well, that's right. And of course, Navarro is one of the more hawkish trade officials in the Trump administration. But the suggestion in all of this, if $100 billion is going from autos and the rest from elsewhere, that does suggest we are headed towards something quite significant when it comes to reciprocal tariffs, and that announcement that's being awaited. I mean, again, Navarro is talking his book a bit there. It's unclear if he represents the full breadth of the administration, because there's a lot we still don't know about what those reciprocal tariffs are going to look like. It seems like the White House is still debating amongst themselves what to actually announce this week. And as you point out, I mean, again, all this money that comes in from tariffs, that's really a price hike for US consumers. It's not a lot of revenue that's going to be collected directly for the US government to replace other forms of revenue for it. It's really a price hike on consumers. And so the knock-on effect you potentially get both on inflation and on growth in the US economy could be significant from this. And then, of course, the flow-on effect on sentiment and on interest rates. So it's a lot of money being talked about. Exactly how it's going to work, we're not entirely clear. But we do know that it could have potentially a massive impact on US consumers.
That is certainly the consensus among economists as well. Bloomberg's Rosalind Matheson, we thank you. Let's stick with American politics here because President Trump told NBC over the weekend that there were ways for him to seek a third term. For more, let's bring in Bloomberg government reporter Jonathan Tameri joining us from Washington. Jonathan, what do we know about Trump's potential plans?
So not a lot, other than that this is something he's talked about kind of in a joking way a lot of times, or he presents it in a joking way. But in this interview on Sunday, he said he was serious about it and there were ways to do it. He did not explain what those ways might be. But what we know about Trump is that he takes this expansive view of his own power. He's likened himself to a king, and often things that he kind of passes off as jokes or just talk are things that he eventually does try to follow through on. He often kind of tests the waters to see what he can get away with. So this seems to be something that he's not just kidding about, that it's something to really, I think, take seriously and keep an eye on going forward, even though on its face, it would seem to run counter to the Constitution.
And just for the history buffs out there, the 22nd Amendment to the U.S. Constitution was enacted after FDR was elected to a fourth term in 1944. That prohibits U.S. presidents from serving for more than 2 terms. And Jonathan, it's worth pointing out that amending the Constitution, that takes years.
Yeah, it's really hard. It takes a significant vote from the states, from within Congress. It's not the kind of thing that gets done very often, and I think would be extremely difficult just given the state of the country's politics. So I don't think it's realistic to think that there would be an amendment to the Constitution that would allow this, particularly when you think about the opposition to President Trump in certain corners of the country. So it would be a case of him probably challenging the law, challenging the Constitution. We've already seen him do this with things like birthright citizenship, where he just has taken written executive orders that, again, are against the plain meaning of the Constitution. So I don't think it's impossible to think about him attempting to do this and seeing kind of how far he can get away with. There's a faction of Congress, Republicans, go along with almost anything he does. So I would not be surprised to see him actually try something like it, even though he would certainly face pushback from many on the left.
Well, let's turn to something that's a little bit more concrete, and that is that Trump officials are planning to appeal a judge's order halting his shutdown of the CFPB. What's the latest there, Jonathan?
So this is one of his many executive orders trying to dismantle parts of the government. On Friday, a judge here in Washington put a halt on it for now, put on a temporary injunction, saying that she's afraid that they were going ahead with these plans, even though she had told them to stop. And so that is theoretically put on hold. They're going to appeal. And this is one of many court cases that are kind of working its way through the system of Trump trying to exert his power as the president and seemingly running counter to laws that Congress has passed funding the CFPB and other agencies. So it's just another test of his power as he's tried to, reach as far as he possibly can in these early months of his presidency.
All right, Jonathan, appreciate you waking up early for us. That is Jonathan Tameri of Bloomberg Government. Meanwhile, let's talk about another member of the Trump administration, an unelected one. That is Elon Musk. He just bought the social network, formerly known as Twitter, for a second time. The billionaire's AI startup, XAI, has acquired X in an all-stock deal valued at $33 billion. Bloomberg's Tom McKenzie joins us now. And Tom, as you know, Musk already owns both of these companies. Did this deal need to happen? What's the logic?
Well, on some levels, Katie, it didn't need to happen because already the two companies work very closely together, both, of course, privately held. But they do share a number of employees, they share a number of investors, and I think that's where the answer lies. It's in the investor base, particularly the investor base underpinning X. and to reassure them that they can get some value out of this deal, because companies and investors like Fidelity have had to write down their holdings in X to 60 or 70%. Now they can get a stake in the prospects of a fast-growing AI company, XAI, and of course the chatbot Grok as well. So as I said, the two companies are already sharing a lot of employees, already sharing in some instances office space as well. And what it allows, and they've already been working on this, is XAI to use the distribution channel of X to push out Grok and other AI products, and of course also to use the data as well, harvesting the data that X has to build their foundation models. Those two things were kind of happening anyway, but this will probably accelerate that. Big questions about what the structure of this new business, XAI Holdings, will actually mean. In terms of valuations, interestingly, the XAI valuation has gone from 50 billion in its most recent funding round now to 80 billion under this metric, and the valuation of X itself has come through at 33 billion, not including debt, which takes it to around the level, 44 billion, that Musk paid for back in 2022.
Well, you bring up an important point for the investors in X. This is great news. Now they have exposure to a super hot AI startup as well. So there you have it. But in other Elon Musk news, he's also lamented his role Doge has had in hurting his company Tesla, that coming over the weekend. You think about Tesla shares down 35% year to date already. Take a tally of the damage for us.
Yeah, and down 45% since what, December the 17th. And of course, you know, the stock was riding high on expectations that the proximity between Musk and President Trump would be beneficial for Tesla, and maybe on the regulatory front as well, particularly when it comes to autonomous driving. But prior to all of that, or as a result, really, of the politics, the brand has soured, not just in the US in some quarters as well, but certainly in countries like Germany, where you've seen a 70% fall in shipments of Tesla in most recent data, about 40% drop over in France as well, because of the role that Musk has played in the domestic politics of those countries. So the stock down about 45% since mid-December, 35%, as you say, year to date. It's seen his wealth be cut by about $100 billion US. And he's come out, he's been speaking in Wisconsin, where of course he's backing the Supreme Court nomination there on the Republican side, meant to be nonpartisan, but that's a different issue. He's been backing that candidate, and he's come out and said, look, I've taken a hit, it's been difficult, but he says maybe it's a bit of a buying opportunity. I guess, you know, our viewers will have to make that decision. The price to earnings is still priced quite richly, Tesla, in terms of the forward look up to the end of 2025 in the 90s level, but of course it has seen that significant drop.
We also heard Commerce Secretary Howard Lutnick make the same pitch when it comes to Tesla shares a few weeks ago. Hasn't exactly worked its way into the stock price yet, but you have to wonder, Tom, what can Elon Musk do here? Not to throw you too much of a wild card, but you've heard a few sell-side strategists suggest that maybe they need to elevate some of their other leadership, show off their deep bench, that this isn't just Elon Musk, maybe try to tamp down some of that key man risk. It doesn't seem like that has happened yet.
Yeah, look, he's got a solid bench in terms of the team behind him at Tesla. How much, of course, can he delegate to those executive teams when they face the challenge, not just of plummeting sales in countries like Germany and France, but of course, so arguably more importantly, the Chinese market as well, given the competition coming through from the incumbents and the smaller players on innovation particularly. So he needs to get a bigger pipeline in terms of the models that are available to buyers, particularly in that Chinese market. On the politics, hard to see how he assuages the concerns, or at least the rift and the pushback he's facing. And you're seeing pictures right now of the attacks on some of the Tesla dealerships, of course, in the US. That doesn't seem to be like a problem he can solve easily. But in terms of the product pipeline and the developments around autonomous driving and, of course, the robotics, his focus will be there, but his focus also needs to be on the Chinese market.
Absolutely, Tom. It's great to see you. That is Bloomberg Daybreak Europe anchor Tom McKenzie. Now, coming up, we'll take a look at what's ahead this week with special elections in Florida, a tariff deadline, and the jobs report. This is Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. Bloomberg has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg.
This is Bloomberg Brief. I'm Katie Greifeld. We do have breaking news out of France, and that is that Marine Le Pen gets an electoral ban in that French case. Remember, earlier she was convicted of embezzlement by a Paris court. Now we have some details here. Getting that electoral ban, though, the judges haven't yet said if that is effective immediately. We know that this is a wildly popular politician in France. We'll continue to follow this story. But that does it for us on Bloomberg Brief. This is Bloomberg.
What would it mean for India to host the Olympics?
Linda, I don't think it's my dream alone. I think it's a dream of 1.4 billion Indians to see the Olympics being held in India. I think once sport takes over, the transformation will be seen, not only in the lives of the youths, but in the economy of our country. India is one of the biggest centers for digital usage, and 1/3 of the viewership of the Olympic channel comes from India. So India as a sporting market is huge.
Countries which have hosted the Olympics have always grappled with the issue of infrastructure, for instance. Building it is one thing, maintaining it is another. How can India do it differently if it were to host the Olympics?
So I think we're talking about innovation and sustainability. And I think the same holds for holding the Olympics. What if you look at a sustainable model? What if you look at refurbishing old stadiums, reusing what we have? So I think the move has to be a sustainable move.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Bringing you a
up-to-the-minute French news whenever and wherever it happens. I'm Caroline Conan in Cannes, and this is Bloomberg.
That consumer element that has changed that's giving us more concern, especially with potentially more tariffs coming.
It's tough. I mean, especially if your market call is tied to anything trade or tariff related, which it almost has to be.
The tariffs are stagflationary.
It's not necessarily about tariffs or actual inflation. It's about inflation expectations.
Once the market understands that this is actually coming through, that uncertainty starts to go away. But that doesn't mean that volatility goes away.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Let's get your very, very long week started. Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Monday, firmly focused on Wednesday.
The tariffs will be far more generous than those countries were to us. They ripped us off like no country's ever been ripped off in history. You'd start with all countries, so let's see what happens.
Let's see what happens. The Post reporting the president is pushing to go big on tariffs, calling April 2nd a generational opportunity. As business leaders look for clarity, Politico suggesting even those closest to the president have indicated they're unsure what Trump will do. That uncertainty helping to sink consumer sentiment and sending long-term inflation expectations to a 32-year high. Following a week full of weak survey data this week, investors will be getting a big dose of hard data with payrolls on deck this coming Friday.
Before we get to Friday, Jonathan, it's Liberation Day on Wednesday, and the reporting over the weekend, even the past 24 hours from the Wall Street Journal, really starts to show a shift in mood, also from what I'm hearing in Washington. Remember, just 2 weeks ago, it was the president might be more lenient, he might be more flexible last week. Someone turned around and said to me, more lenient from what? Maybe a 50% tariff rate that will come down. It looks like he's going to be a little bit more aggressive. The big question is that set in stone, or is that the opening salvo potentially for negotiations down the road?
I think that's a major question for markets too. Anne-Marie, equities are down by 0.9% on the S&P. Mike Wilson joined us a little bit later from Morgan Stanley. The top of his note over the weekend, this week's reciprocal tariff announcement is likely a stepping stone for further negotiations as opposed to a clearing event. Which one is it?
Well, we don't know yet. But if it is going to be a stepping stone for negotiations, that means that uncertainty will be more pervasive in this market for the next few weeks and even months. Something also interesting is happening tomorrow. When President Trump came in, he directed his trade agencies, USTR Ambassador Jamieson Greer, to look into trade imbalances. That report is due to the president tomorrow, April 1st. A key question everyone in Washington is talking about is whether or not the administration will make that public or potentially we can get some leaks. So then when April 2nd comes, 24 hours later, a little bit more of understanding of what the base case is that the president is thinking about when it comes to trade.
We've already said it a few times. This week is a massive week for economic data. Concludes on Friday with payrolls. You'll hear from Chairman Powell as well on the very same day. Friday feels like a long, long way away. We've been talking about what these tariffs mean for prices, higher prices. The president over the weekend, with these comments on autos, that he does not care if prices go up. Here's the quote for you to NBC. I hope they raise their prices because if they do, people are going to be buying American-made cars. Comments from the president over the weekend.
So I think one thing the president is trying to, or the administration wants to direct when it comes to those comments, is not that Americans are going to be paying higher prices for cars or automobiles in general. That is not the message that they want out to the public. But they're leaning on the fact that for foreign cars, he wants Americans to buy American-made cars. The issue is you have American brands that import some of their cars into the United States, especially if you consider Mexico and Canada outside of the U.S.
The forecasts are already changing on Wall Street. Some big moves over at Goldman Sachs. Look at this for a mix. These are the latest calls from Goldman. 3 Fed cuts, PCE at year-end at 3.5%, GDP cut to just 1%. 1% for 2025. David Kostner of Goldman Sachs, who already cut his price target on the S&P 500 in the last month, does so again. New target, 5,700.
And we're only in March. And the issue is right now is that if you're taking your direction from Washington, the policy has been squarely focused on what President Trump can do unilaterally, and that's tariffs. We have yet to get to the end of the year when maybe there's going to be a more holistic approach when it comes to the Trump administration and their proposals. I'm talking about the deregulation and the extension of TCJA and maybe some extra
tax cuts.
Let's go through the markets for you. Equity futures right now down by 1% on the S&P 500. A bit into the bond market. Yields lower across the curve. A big hour coming up. Laurie Calvasina of RBC with stocks on a 3-day losing streak. Robert Sarkin of Citi as global economies prepare for tariffs. And Sucharita Kadali of Forrester as consumer sentiment plunges. We begin this hour with stocks falling as Wall Street awaits Liberation Day. Laurie Calvasina of RBC writing, with the S&P ending the week down more than 9% from the February high. The next few days are once again pivotal when it comes to the path of the US equity market from here. I'm pleased to say that Laurie joins us now for more. Laurie, good morning. It's good to see you.
Good morning. Thanks for having me.
Let's get to it. I mentioned David Costin. Just to re-clarify that, the target now on the S&P 500 for Goldman on a 12-month return forecast is 5,900. 3-month, 5,300. Where are you and the team now?
So a couple of weeks ago, we actually took our number down from 6,600 to 6,200 at year end. Now that's our base case. We've also been running a bear case, which you can think of as a shadow target. If we break 10% from the high, and it doesn't have to be 10% on the dot. We went 10.1 at the low, but if we break too far below that, we think our bear case probably kicks in. I will say, in terms of my base case modeling, there's a very wide range of outcomes implied if you look at the 5 different models that we use. And so it's a very quantitative approach. 6,200 is basically the median. My sentiment indicator tells us to all calm down a bit, right? And that is actually one of the median outcomes. It gets you to around 6,200 on the S&P, and it basically looks at the AAII net bull bear indicator, which is down around GFC lows. And typically on a 9-month forward basis, you're up more than 10%, about 10, 11%. Putting that aside, 2 of my more bearish models are actually coming up with similar numbers to Costin's new target. And so that's weighing down that base case forecast. So my GDP modeling and my economists have taken their number down to 1.6 for the year. You typically are down about 3.4% in the equity market in years where that happens. So that gets us south of 5,700. If you look at my valuation modeling, which bakes in higher inflation, weaker 10-year yields coming down a bit, no cuts from the Fed yet, from our team at least, that along with my new earnings number, will get us around 5,750 on the S&P. So there is a wide range of outcomes in here, and as Anne-Marie mentioned, it's early in the year. A lot can happen, and things do tend to feel pretty terrible at the bottom.
A lot can happen this week. Liberation Day on Wednesday, payrolls on Friday. You'll hear from the chairman too. Can you give us a reason to be calm in the face of all of that?
I think the reason to be calm, it just kind of goes back to this is what bottoms feel like, and bottoms do tend to be a process. Now, I will caution you that when you look at those periods when AAII net bulls have been this bad, we tend to get stuck there for a while. We don't necessarily always bounce right back up. I'll tell you one thing, and I forget which sentiment survey it was, and we've had so many of these things. Actually, I think the Duke CFO survey showed that the tariff concerns had really increased versus last quarter, but monetary policy concerns were actually pretty low. So I do think, it's nice to hear from the Fed speakers and get their read on things, even when they're saying things are uncertain. I think it actually resonates pretty well with Washington.
How are you thinking about Wednesday? Is it a clearing event, or potentially are we going to have more uncertainty depending on what the president does?
In my mind, it's sort of the battle versus the war, and maybe we get more clarity on this particular tariff battle. But one of the things my colleague Halima Croft keeps reminding us about is that this is an administration that approaches foreign policy and economic policy in a different way, and there's been more unity and more intersection between those two things than what we've been used to on Wall Street in the past. So I feel like I'm holding out some hope that we will get some clarity and businesses can start figuring out how to adjust their supply chains. We'll see, but even beyond that, I do think we're in a bit of a new world here, and it's going to continue to be tricky for people to navigate.
If it is an opening salvo, though, and there's going to be negotiations, does that just mean corporate America has to continue to remain on the sidelines? They can't make decisions?
Yeah, I think that's fair. And, I spent some time last week, sort of reading through consumer transcripts, trying to see, what companies are saying about the current environment, and kind of got sucked into a tariff discussion. That's not why I took up the project. But I found that they started talking about their guidance and what's baked in. And, some companies are putting China in, not too many putting in Mexico or Canada, but there's just not really a lot of clarity from the companies on how to even think about this stuff. And so when I look at the rate of upward revisions to S&P 500 EPS forecasts, we're still getting like 40% to the upside. That's unbelievable to me. I think it's because companies haven't really been talking to analysts, and analysts don't really know how to adjust their models yet.
We've had the consumer sentiment numbers. They're dreadful. How much weight should you put on, say you, Mitch, on Friday? The chairman of the Federal Reserve comes out a number of weeks ago and says he's not putting much weight on it at all. And then the number comes out on Friday, and it's even worse. What do you do with those figures?
The thing is, it's not just one survey, right? We're seeing a deterioration now in corporate sentiment. We had 3 different C-suite surveys that came out in the month of March, and they all 3 ticked down. NFIB has moved significantly lower. The Conference Board data has been weak. And they're all showing the same thing, which is that there's concerns starting to emerge on the employment front, both from a bottom-up basis from the consumers who are looking for jobs, and the companies are also signaling a little bit of softening. So if it was just one survey, you know, we could dismiss it as an outlier. Surveys are only as good as the people they actually poll and their methodology issues and that kind of thing. But this is widespread. This isn't just one survey. This is every survey.
The headlines coming from you, Mitch, if you missed them on Friday, are pretty awful. Consumer sentiment at a 2-year low. Long-term inflation expectations, 32-year high. On unemployment, 2/3 expecting unemployment to rise in the year ahead. That anxiety, if that starts to take hold, I imagine people aren't going to spend in the same way they were. So when you look at what's been discounted for the consumer-facing companies, do you think we've discounted enough?
So even on the earnings numbers that are out there, I'm not really seeing anything in my industry modeling that's telling me that I've got a group that's got both, you know, significantly cheap valuations and decent earnings revision trends. I've got a handful of groups that are slightly cheap on earnings that still probably need to come down a lot more. So I don't think you've opened up enough opportunity in that consumer discretionary sector yet. I think it is the right place to look for a rebound. But I just think there's too much confusion about what those earnings estimates actually have to bake in going forward.
What caught my eye as well on Friday was that expectations for high-income consumers also sank. So is any company safe out there?
You know, it's interesting. If you look across the consumer company landscape, they're not really talking too much about high-income consumers at this point in time. I did similar exercise back at the beginning of March, and I found one retailer that said that they were seeing a weakening across income cohorts. But for the most part, we're just seeing comments of general softness. I do think what's interesting is they're not blaming it on the low-income consumer as much as they were in the past, which is probably telling me they don't have a clear read, but something is going on. And look, this is a concerning data point. I'll tell you, hedge funds in particular, it's been sort of a battle to get them to pay attention to this data because they have, you know, sort of said, look, this is post-election, Democrats are feeling worse, Republicans are feeling better. That was true like 3-4 months ago. If you look at these surveys now, every cohort is coming down. Independents, Republicans, Democrats, there is something that has changed, and it is starting to seep into this sentiment data. And we noticed, particularly in February, the consumer companies were seeing something happen as well.
It's seeping into the market too. Laurie's going to stick with us. Laurie Calvasina of RBC. Equities at the moment near session lows as we kick off a major trading week here stateside. Equity futures down 1% on the S&P. With an update on stories elsewhere this morning with your Bloomberg brief, here's Yahara Hackers. Hey, Yahara.
Hi, John. The head of France's National Rally Party, Marine Le Pen, was convicted of embezzlement by a Paris court and has been banned from running for office. Le Pen and her party were found guilty of diverting millions of euros in EU funds to finance activities related to their domestic agenda. Le Pen denied wrongdoing and claims the prosecution is seeking her political death. Meanwhile, here, President Trump says he expects consumers to move to U.S.-made cars if automakers raise prices in response to 25% tariffs on imported vehicles and parts. The president saying in an interview with NBC News on Saturday that he couldn't care less if car makers hike prices. And the death toll from Myanmar's earthquake is expected to rise from over 1,700. More than 3,400 people are injured and over 300 are still missing following Friday's 7.7 magnitude quake, which was the biggest in a century. The country declared a week of national mourning starting this morning. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate that. More from Yahara later on this hour. Equities lower on the S&P. We're down 1%. Up next on the program, counting down to Liberation Day.
The tariffs will be far more generous than those countries were to us, meaning they will be kinder than those countries were to the United States of America. You'd start with all countries, so let's see what happens.
2 days to go. Up next on the program, Bloomberg's Laura Davidson joins us next, and we'll have more from RBC's Laurie Calvasina from New York City this morning. Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
So here's a snapshot. 3-day slide on the S&P could become day 4. Equities right now negative by about 1% on the S&P. On the Nasdaq 100, we're down by 1.3. In the bond market, we receive a bid. Yields are lower across the board on a 2-year, 10-year, and 30-year. 10-year bond yields down by 5 basis points to 4.1938. Tons of economic data coming up this week. Of course, Liberation Day is Wednesday. After that, you're going to hear from jobless claims, ADP, ISM, payrolls on Friday, and Chairman Powell speaking Friday afternoon. Do not miss that. Under surveillance this morning, we're counting down to Liberation Day.
The tariffs will be far more generous than those countries were to us, meaning they will be kinder than those countries were to the United States of America. You'd start with all countries, so let's see what happens. There are many countries. I haven't heard a rumor about 15 countries, 10 or 15.
So you're starting with all countries?
Essentially, all of the countries that we're talking about would be talking about all countries. That's not a cutoff.
So here's the latest this morning. President Trump pressing forward with reciprocal tariffs on all countries. The president tamping down speculation he could narrow the initial scope of tariffs set for Wednesday. Bloomberg's Laura Davison joins us now from Washington for more. Laura, welcome to the program. What do we know about what we might hear in 2 days' time?
Well, we know that Trump has repeated now multiple times that he is going to apply these reciprocal tariffs to all countries. Beyond that, we don't know for sure. The administration has been debating a bunch of things, whether to expand the aperture of these or narrow them down. Trump is getting pressure from his aides to narrow the scope here, where Trump is pushing them to say, hey, let's go the most maximalist approach here. We got a little bit of a glimpse of kind of how big and what the size and scope could be over the weekend. Peter Navarro, the top trade aide at the White House, said that the auto tariffs in particular would bring in about $100 billion a year, and then those reciprocal tariffs, another $500 billion, for a total of $600 billion in tariffs annually. So that just gives you a sense of, what we saw last week with the auto tariffs, about ×5 for what we could see coming later this week.
We also heard from Kevin Hassett, of course, his NEC director. This is what he had to say over the weekend. I can't give you any forward guidance on what's going to happen this week. The president's got a heck of a lot of analysis before him, and he's going to make the right choice, I'm sure. Does everyone in the administration actually know what the president is planning to say or do on Wednesday?
No, they don't. And there's a bunch of different options here. One is it could just be an announcement of some sort of study for future tariffs, or it could be anything all to, hey, there are tariffs that are going to go into effect, here in just a couple days. The thing that the administration is trying to do, this reciprocal tariff plan of looking at all of the tariffs as well as what they're calling non-tariff barriers, so things like value-added taxes or digital services taxes, and come up with some number. That's a very, very complicated task. This would be a bigger task than USTR, the U.S. Trade Representative, has ever done in the past. So there's some concern that just logistically they may not be ready for that April 2nd date.
And Laura, of course, there's 2 things to watch tomorrow. We get that strategic document from Jamieson Greer that the president wanted done when he came into office, looking at all the trade imbalances between the United States and other trading partners. And on top of that, the Senate is also expected to have a vote on the use of IEEPA when it comes to Canada. What does this all mean in terms of politically for Republicans in Washington?
It means that they are trying to kind of build this case to take to voters. There's already concern within the administration that farmers are getting very worried and that they could bear a lot of the brunt of this. We also see in the Senate this week that they're going to take initial steps on advancing that tax cut bill. So you're kind of seeing here that the senators are very worried about tariffs and looking to make sure that there's some counterbalancing measures, some things that they think will help juice the stock market and grow the economy.
Laura, appreciate the update. As always, more from Laura Davison throughout the week, anticipating Liberation Day, just 2 days away on Wednesday, and a massive week ahead in terms of economic data. If you are just joining us, welcome to the program. Equity futures here down across the board on the S&P, on the Nasdaq, the Russell, on the S&P 500 at the moment, negative by 1 full percentage point, and some big changes on Wall Street as well, some revisions to the forecast. This from Goldman Sachs. They now anticipate 3 cuts from the Federal Reserve for 2025. On the inflation side of things, the forecast PCE 3.5%, on GDP just about 1%. Laurie Cavacina of RBC still with us around the table. Laurie, I'd love your thoughts on those forecasts from Goldman. This stagflationary mix, let's just assume this is how things turn out. What on earth do market participants do with numbers that look like that?
So the thing, well, I'll say on the PCE number, if we were to get something like that, that's a direct input into my valuation model. And so the higher the PCE, the lower the multiple. That's the price you pay. And what I've found in my valuation modeling is that movement in the inflation number offsets the movements in the 10-year yields. So 10-year yields come down, that helps offset, but it doesn't completely take away all that damage.
Bond yields are lower this morning, particularly the front end. And this is the interesting thing, Laurie, just to jump in, to see the 2-year yield lower. The Federal Reserve, is it able to respond in an environment like that one to climbing unemployment?
I think they're going to have to look at their mandate, right, and decide what the sliding scale is, right, because they've got these 2 twin pressures. They need to fight inflation. That didn't go so well before. The word transitory has been coming back into the conversation. I don't think anyone really wants to hear that word. My guess is maybe they err on the side of going with the labor market, but we're going to have to see what they say.
At the same time, long-term inflation expectations are at a 32-year high, according to the University of Michigan. So how does the Fed do both?
It's tough. And look, I will say from the inflation perspective, even if tariffs weren't an issue right now, there were plenty of economists that were still concerned that the inflation genie hadn't been put back in the bottle. And I know that's one thing we saw in looking at our corporate earnings analysis was just that inflation was something that companies were still complaining about at the end of last year when people weren't even all that concerned about tariffs.
So if consumers are concerned about going out and spending, and at the same time they're also concerned about prices going up higher, they're not going to go out and spend, then companies need to basically make ends meet elsewhere. Are you expecting layoffs?
Well, it does look from the survey data, right? Again, whether you're looking on the corporate side, and I stress looking on the corporate side, not just the consumer side, that seems like the lever they want to pull. And there was a big discussion about CapEx expectations coming into this tariff discussion, and everyone said, well, is this going to, make companies scale back on CapEx? And we're just not getting that color. What we are getting the color is on the layoff side. And I think what you're seeing in the consumer surveys is even if that fear is overstated, that fear is absolutely there. So you're starting to hear discussions of, is the consumer shifting? Are they retreating? It does look like it's a bit of both, but it does feel like savings are starting to increase.
Laurie, as you know, this has only been one part of the story. We've focused on trade for the first 20 minutes of the program, but big tech has been absolutely hammered. Tech's in a bear market, never mind a correction. Some of the biggest stocks on the planet are in a bear market, and that's got to do with overcapacity, and CapEx is part of that story too. So let's sort of think about the last week or so. The Alibaba chair came out and said that we could be in a bubble. Speculated about overcapacity in data centers. TD Cowen said Microsoft was pulling back in both Europe and the United States as well. It's just pressure, pressure, pressure ever since DeepSeek. How do these stocks bottom?
So look, I would say on the DeepSeek issue in particular, we did see that companies after that came out, I think did a pretty good job of coming back and answering those concerns. And we, of course, hear all this concern about CapEx and the bubble issue. But I think what's really going on, John, is that you've got money coming out of the U.S. from European investors pulling it out. And if I think back the last couple years, every time I go to Europe or get on the phone with a European investor, all they want to talk about is tech, 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 Mag 7, growth versus value. If you are pulling money out of the U.S. in terms of what their interest has been and in terms of the market capitalization of the indexes, if you're even doing it through the ETFs, you are pulling money out of those names. And so until we get that pressure on money coming out of the U.S. from European investors in particular, I think it's going to be very, very hard for that part of the market to work.
Any reason to believe that stops anytime soon?
So I will say we've been watching the EPFR data, and they have some data that will let you sort of isolate by geography. And we did actually see in last week's update, the money in Europe, it sort of eased in terms of that outflow that we were seeing coming out of the U.S. I think it may have actually turned slightly positive. But what was interesting, John, when we looked on the U.S. side, U.S. investors started taking money out of the U.S. So the Europeans may have calmed down just a little bit for a minute, and then the U.S. investors, kind of stepped up and took over the selling pressure.
Laurie, just wonderful to catch up with you. Massive week ahead. Laurie Cavacina there of RBC, breaking down expectations. There's been a major sentiment shift so far this year from the United States back towards Europe. Can that stick in the face of the kind of tariffs we might see in 2 days' time?
Well, if it's a universal tariff or even if it's a reciprocal tariff, plus remember the VAT that they want to make up for, you could be looking at a tariff rate on European imports of potentially minimum 15% and as high as 20% or even more. So at that point, do you see the flow start to reverse and the story start again with U.S. is the cleanest dirty shirt in town?
Liberation Day is 2 days away. We're all waiting for reciprocal tariffs from the President of the United States. He stressed over the weekend those tariffs would be on all countries, not just a select few. Kicking off the trading this morning, equities are down by 1% on the S&P 500. Nobody has any idea where we're going to finish this week. At the moment, this is how we begin. Down across the board on the S&P, we're down by 1 full percentage point with that risk aversion, money going into bonds, yields down across the curve on a 2-year, 10-year and 30-year bond yield. Up in just a moment, joining us on this program, Robert Sarkin of Citi, as global economies brace for a fresh round of trade tariffs. Live from New York City this morning, good morning to you all. You're watching Bloomberg TV.
In case you missed it on Balance of Power.
The statute governing the FTC says commissioners can only be removed for cause. Was there any indication that you were fired for cause?
No, there was no claim of cause, and the statute actually specifically says cause means neglect, malfeasance, or inefficiency, and there was no claim of any of those.
So as we talk about some of those other examples, keeping in mind we are having this discussion with you on the day we got a Fed rate decision, is this directly applicable to what is supposed to be an independent central bank? Is that one way in which market participants should be looking at this?
Yes, that's exactly right, and market participants should be scared. To be clear, there's no legal difference between Jerome Powell and me. In fact, he and I were both originally appointed by President Trump, and if the president can illegally remove me, he can illegally remove Jerome Powell. People should be very worried about that.
Don't miss Balance of Power live every weekday.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Three-day slide on the S&P. Here's day 4. We're down 0.9% on the S&P 500. The S&P, 5 losing weeks out of the last 6. Friday, the second worst day of the year so far. We're down on the month by 6%. The worst so far, going back a couple of years. On the Nasdaq, we're down by 1.3%. We're 3 hours away from the cash open. Let's get you some morning movers with Yahara Hacker. So, Yahara.
Hi, John. We'd start with Tesla shares down 4.6%. And leading the Mag 7 lower on this jittery Monday morning. And this is after Musk had some pretty sobering words about his role on President Trump's Doge team and how that's affecting Tesla. He spoke at a town hall in Wisconsin and said the Doge job is costing him a lot and pointed to the shares plunging. I will note they are down 45% since their December peak. Next up, we have Oracle shares. Those are also down 2% after we reported that the FBI is investigating a cyber attack at the company, which led to the theft of patient data. The hack happened sometime back in late January, but it didn't start notifying healthcare customers until this month, and we don't yet know how many people were affected. And last up, we have the latest member of the Nasdaq Core Week. Those shares are down nearly 4% here after the company had a muted first day of trading Friday. It was seen as a test for the IPO market and, of course, meant to test investor appetite for a pure AI play company. But it seemed to fall short at a time when we know we've seen tech struggling overall. And today, not looking any better. John?
The hits keep coming for the AI trade. Yahara, thank you. More from Yahara later on this hour. If you are just joining us, futures down across the board. A bit into the bond market. Bond yields lower on a 2-year, 10-year and 30-year bond yield. On our radar this morning, President Donald Trump saying reciprocal tariffs will target all countries. His comments tamping down speculation that he could limit the initial scope of tariffs set to be unveiled this coming Wednesday.
So the tone had shifted from universal tariffs on the campaign trail and inauguration, and then the last 2 weeks, 3 weeks, this word reciprocity. We're going to look country by country, and potentially the scope will only be the dirty 15. The president put that to bed yesterday, saying, no, I'm looking at all countries. And now the reporting you're seeing, whether it's the Washington Post or the Wall Street Journal, looks like this universal tariff is back in play. The question is, how high is it going to be? And the bigger question for this market is this an opening salvo for deals, or is this going to be the new way of trade when it comes to Trump 2.0?
Negotiations are a clearing event. I think the market's just hoping it's a clearing event and we can move on, but that's hopeful. Wishful thinking in the minds of many right now. The president said this over the weekend, the tariffs will be far more generous than those countries were to us. We've heard that repeatedly. What is that? Is there any substance in that line at all?
I think what he's saying is we are going to be kind, lenient, flexible, but I think you need to think about where the base case is. So potentially we're going to be kinder to European autos than they've been to us over the past few years, one of his biggest grievances. But I think what someone quipped to me over the weekend is the fact that when I said the president said he's going to be lenient, he's going to be flexible, they said, yeah, from what? He was thinking about a 50% tariff rate. Maybe now he's thinking about 15 or 20%. So I'm not too sure about that.
Everything's relative. If you are just joining us, we're looking at crude as well. So Brent and WTI up this morning by about 0.25% to 0.6% on WTI and Brent, respectively. Secondary tariffs. President Trump threatening secondary tariffs on Russian oil. NBC News reporting Trump said he was, quote, pissed off at Russian President Vladimir Putin for casting doubt on ceasefire negotiations with Ukrainian President Volodymyr Zelensky. Not the first time we've heard about so-called secondary tariffs. Heard it with regards to Venezuela only last week or 2 weeks ago. I'm losing track of everything now, Anne-Marie. And now Russia in focus, which would have to mean China and India also in focus.
China and India in focus, because basically that's where all the Russian crude goes since Russia's invasion of Ukraine. And that would mean that if they wanted to still import that Russian crude, they would have to pay a fee, hypothetically, if this was to happen, to the United States. I would also say when the president was talking about this, when you read the transcript from NBC News, he pretty much interchanges tariffs or sanctions. But basically, at the end of the day, what he is saying is, if Putin doesn't come to the table, and I have reporting that he wanted to see a full ceasefire by April 20th, if Putin doesn't come to the table, there potentially is going to be more financial penalties.
Played golf with a Finnish leader over the weekend. What came of that? Is that what led to these comments?
There was about a 5-7 hour meeting between these two, including a round or two of golf. What the Finnish President Alexander Stubb had said to the Financial Times following his meeting with the president was that the U.S. President, Donald Trump, was, quote, running out of patience with Putin over the ceasefire. What you hear from European sources is that they are concerned that the president is moving at this aggressive pace and Putin is just trying to drag it out and slow it down to try to get more concessions.
One more thing on a long list of things to watch coming up this week. Big changes over at Goldman, so let's get to it. Over the weekend, a busy research team. Goldman raising its forecast for the number of Fed rate cuts this year from 2 to 3, expecting President Trump's tariff to weigh on economic growth. This coming as Goldman's David Kostin cuts his S&P 500 year-end target for a second time in only the last month. Jan Hatzius also busy. On a growth side, now looking for just 1% GDP growth at year-end, 3.5% on PCE. That is an ugly mix for the economy.
What stuck out to me, obviously, because I'm so focused on tariffs and policies, is Goldman Sachs increasing their tariff assumptions. That's for the second time this month. On top of that, Jonathan, raised their 12-month recession probability from 20% to 35%. That R word is something that this administration does not want to see circulate.
So Goldman offering a 3-month forecast, a 9-month forecast, and a 12-month forecast. So these are the numbers: 5,300, 5,700 and 5,900 from David Kostin now. I believe we were only at 6,200 for year-end, so the 9-month view, only a few weeks ago.
And we're only in March. So I think it's also important to think about the fact that, can this story change by year end? One, depending on what happens on Wednesdays, an opening salvo to negotiations. Will there be carve-outs? Will there be exemptions when it comes to tariffs? Then on top of that, that is only one pillar of this triangle when it comes to the holistic approach of the Trump administration economic agenda. What happens with deregulation? And what do we get on the tax front by year end?
Futures down by 0.9% on the S&P. Global economies bracing for President Trump's Liberation Day. Robert Sokin of Citi writing this: for 2025. The global economy is feeling the effects of a marked transition of President Trump's policies. We see global growth this year running at 2.6%, down from 2.7% in our previous forecast. Robert joins us now for more. Rob, good to see you.
Morning.
Very marginal change to the forecast from you. Some bigger changes elsewhere. Why the small change from you and the team?
There are a couple competing factors. Even though China has been facing a lot of risks and actual headwinds from the tariffs of the Trump administration, we raised our forecast there from 4.2% to 4.7% on the back of some signs that momentum's picking up there, a little bit of the AI story as well. At the same time, we lowered our U.S. forecast by about 50 basis points due to an increase in expectations for higher tariffs by year end. So when you net all of those competing factors out, you get a little bit of a change in global growth, but I think the risks here are distinctly to the downside.
Let's focus on the U.S. piece of it. You talked about the downgrade. Where are you now?
We're at around 1.9%, so we would have been somewhere closer to the mid-twos before this, so it's at about 50 basis points less growth due to a higher expectation of tariffs. Also about 50 basis point higher inflation forecast, somewhere in the high 2% range, 2.7, 2.8 probably by year end. And again, that's in a 1 month change, and really the tariffs could get even higher than we're expecting in our base case. Growth can get even lower, inflation could get even higher. So that's where the risks are.
What is your base case for tariffs?
Well, you know, before Trump came to office, the U.S. effective tariff rate on all imports was a little over 2 percentage points. We're expecting that to rise by year end. So there could be a lot of noise, a lot of things coming on and off, about 10 to 15 percentage points. If we get that lower end of the range, that's already the highest effective tariff rate since the 1940s. And we could get, as I said, I think the risks are we get to that 15-point rise.
So you're looking at a universal tariff, not country-by-country reciprocal tariff.
We're looking at, and there's a lot of different ways you could get there. We don't expect that large tariffs on Canada and Mexico will stay. We think they're moving towards a deal eventually in that space. So our base case is a mix of the China tariff sticking, reciprocal tariffs defined kind of traditionally, which would mostly hit emerging markets, just which countries have higher traditional tariff rates than we do, and sectoral tariffs, so things like the car tariffs that we saw. I think we'll get things on like pharma, other major products, and that's how we kind of get to that range. So not universal, but still you could get there.
How do you price in the retaliation we can maybe expect from all these trading partners?
I think that's really a big question. So right now, that 0.5 point off U.S. growth I mentioned, that is assuming probably what I would describe as minimal retaliation from trading partners, so very little. And I think what we've seen from a lot of different counterparts is they're very hesitant to put large-scale tariffs on their own consumers and really get into a large-scale fight with the Trump administration. If you were to get kind of tariffs of similar size placed on by other countries, you could get 3 times the effect that we have as a drag on the U.S. So not 0.5%, but something like 1.5% off U.S. growth.
Let's get to the calendar this week. JOLTS, ISMs, ADP, jobless claims, payrolls, and a whole lot more. We've seen the survey data, pretty convincingly bad. Are you expecting it to show up in the hard data as soon as this week?
That is the key question. If you look at, there's kind of 2 different worlds in the U.S. data right now. All of the soft data measures, the consumer, the business, financial market administration, policy uncertainties that play through. Hard data, more mixed, holding up pretty well, especially the labor market. Unemployment rate still looks pretty low. Jobless claims still very low, even in areas where you might be more concerned, like around the D.C. area with a lot of the layoffs that have been happening there. So we think the data are going to hold up still pretty well now. So we're not going to see that really bleed in yet. But of course, again, the risks are that you start to see that more significantly.
It's stunning to see the data where it is, the survey data. You've really got to take a step back and think about where it is right now. We're talking about levels exceeding where we were when inflation was approaching double digits and the Fed was hiking by 50, 75 basis points at each meeting with no end in sight. Are things really that bad compared to where they were back in 22?
Yeah, and it's a good question. And when and again, we have to take it with a grain of salt because some of these surveys, when you look at, there's a big difference in political affiliation and what they expect on the economy. And as we know, we saw in prior years in this cycle, consumers at times were very upset if you look at the consumer confidence measures, but they kept on spending and the consumer performed very well. So we have to see how it actually translates. But I think this is the big risk for the Fed that they have to monitor is a lot of the soft data are telling them that things are going to get worse. Hard data, kind of mixed, a lot of noise in the first quarter, but overall okay. And they're going to have to see how that balances out and monitor all these things closely. It's a very difficult time to be forecasting the economy.
How concerned are you that this becomes a self-fulfilling prophecy?
Yeah, and that 0.5 point off of growth I mentioned for the U.S., I would describe that as really kind of the pure tariff effect, not really baking in a lot more of that uncertainty, spiraling into a self-fulfilling prophecy. But I do think that's a big risk, especially because what we've seen in the U.S. is it's been increasingly upper-income consumers that have been driving the consumption cycle. And not only are we seeing things like confidence come off, but with equity prices coming down, that could have a negative wealth effect. And this really could feed into, even though those consumers still have fairly good labor market prospects, still have jobs, that could feed into them pulling back, at least temporarily. So I think that's another huge risk on top of the how high do tariffs go.
We've spent some time talking about the stagflationary-like forecast coming out of Goldman Sachs, led by Jan Hatzius and the team. I'd love to know from your perspective whether that's a mix that this Federal Reserve can respond to. If you have growth coming down to 1, you don't, but let's run with it. You have growth coming down to 1 and PCE up there at 3.5%. Can the Fed cut rates?
That is a really difficult balancing act. I think if you end up with a forecast where growth is somewhere in the 1% range, risk to the downside, inflation is kind of in the upper 2s, that's a spot where I think the Fed can focus more on the growth side of its mandate, less on the inflation side, and really cut rates. I think once inflation starts to pick up above 3, especially if it's broad-based, if we start to see things like the tariffs going into spilling over into services inflation expectations higher, it's going to be very difficult for the Fed to cut significantly. So I think when you get above 3, that's when it gets a little dicey and it's quite uncertain.
The central banker's dilemma. We should call it the central banker's nightmare. Downside risk to growth and upside risk to inflation. If we get it, it's tough to see how they'd respond to it. Robert Sarkin of Citi, good to see you. Rob, thanks for your time. Equity futures recovering somewhat. We're still negative by 0.9% on the S&P 500. With an update on stories elsewhere with your Bloomberg brief. Here's Yahara Hacker. Say Yahara.
Hi, John. CK Hutchinson shares fell the most in nearly 2 weeks on reports that billionaire Li Ka-shing may delay signing a deal to sell the company's Panama Canal ports to a consortium, including BlackRock. Trump has touted the deal as a win, but Beijing views it as a threat to its trade interests and has reportedly ratcheted up criticisms of the deal. Meanwhile, more on Elon Musk's rally yesterday in Wisconsin. The billionaire head of Doge questioned the relevance of the Federal Reserve, saying, why are there so many people at the Fed and what do they do? Musk went on to say he thinks a magic 8-ball could do a better job with interest rates than the Fed. And President Trump isn't ruling out running for a third term as president. He told NBC News there are methods that would allow him to run again. The 22nd Amendment, though, to the Constitution enacted after FDR was elected to a fourth term in 1944 prohibits presidents from being elected more than 2 terms. That's your Bloomberg Brief. John?
Yahara, thank you. Can we squeeze some baseball in next time? Anne-Marie has thoughts on that torpedo bat. Got a lot of thoughts, haven't you?
It's MLB approved. People were using it last season. Aaron Judge isn't using it. And if you think it's helping you so much, then I'm for it. All teams should be using it then.
So the Yankees aren't cheating?
It's more exciting if there's more home runs in a game.
Agreed.
The Yankees are not cheating. They're just crushing it.
AMH, I agree. I saw the headlines and I thought, you know what, I actually might get some tickets if it's that exciting, if it's helping that much.
We should get tickets.
More on baseball in the next hour, and we can debate whether the Yankees are cheating or not. Apparently they're not. Maybe they are. Equity futures on the S&P down by 0.9%. Up next, a cautious consumer.
There's so many red flags that tell us we should be in a pullback, we should be in a recession, but the consumer was always there. It's that consumer element that has changed that's giving us more concern, especially with potentially more tariffs coming.
A conversation about retailers in just a moment. We'll be speaking to Sucharita Kodalia Forrester from New York City. You're watching Bloomberg Surveillance.
Behind the bright lights and adrenaline of pro sports is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I love the fact that you have, we say the cojones. Can't say that in Bloomberg.
Maybe moxie.
Yeah, moxie. I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Billie Jean King.
Well, what should I learn? What should I do? I said, learn the business.
Jay Williams.
You're the asset, but how do you become the principal?
Paul Rabel.
We're going to be the league of digital, and that's why you're going to invest.
Adina Friedman.
I definitely am competitive.
David Rubenstein.
People don't come up to me on the street and say, let's talk about this private equity deal you did recently. No, nobody does that. They say, let's talk about the team.
And so many more.
You need a clap?
No, I never Ready? Go.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Equities down and Wall Street adjusts. We're down by 0.8% on the S&P. Had cuts on that target from Goldman, RBC, and Barclays. Goldman go twice. Started the year at 6,500. That was the original forecast for year-end 25. Cut to 6,200. Now reduced to 5,700 on the S&P 500. The Nasdaq lower too. We're down by 1.2%. Under surveillance this morning, a cautious consumer.
There's so many red flags that tell us we should be in a pullback, we should be in a recession, but the consumer was always there. We talk about a Fed put or a Trump put, but really it was the consumer put for the longest period of time. Consumers are starting to pull back, and you get in that negative feedback loop. As the consumers start to pull back, it's that consumer element that has changed that's giving us more concern, especially with potentially more tariffs coming.
So here's the latest this morning. Concerns about the consumer mounting after UMich consumer sentiment tumbled to a more than 2-year low, and inflation expectations spiked to a 32-year high. Sucharita Gedalia Forrester writing, retail is holding steady, but around the same pace as inflation. This suggests that consumers are definitely more cautious. Sucharita joins us now for more. Sucharita, you heard those comments there. Do you believe we are in that so-called negative feedback loop?
For sure. The consumer has definitely had very, very negative shopper sentiment for some time. The big difference is that they're actually spending lower now. There was a lot of cognitive dissonance following the pandemic where consumer sentiment was low because of the inflation numbers, but yet the spending numbers were really high and they were really outpacing inflation. We're not seeing that anymore. We're seeing sectors like, for instance, food and beverage, which were doing really, really well, and typically is the signal that people are still able to spend discretionary funds. They have discretionary funds. Those seem to essentially have evaporated, and the consumer is spending less, and that is really the signal that everyone is going to be looking for. Consumer sentiment was just sort of a concerning factor, and it certainly affected elections and things like politics. But they didn't actually affect business. And now that we're actually going to see that in retail.
The numbers we've seen on the survey side have been shocking. We have heard from a handful of companies, if you've alluded to. We heard from Delta Airlines over the last month or so. We heard from Lulu just last week. Sucharita, going into earnings season, do you believe we have sufficiently reset expectations or not yet?
Well, I think that there probably is still, to some degree, a level of a correction coming. Certainly the market is down, and many of these retailers are down to their lowest level in the last 12 months. But there may very well be more to come, because I don't expect that they are going to improve any of their expectations in future earning calls. And we also have the challenge with consumers pulling back. And if consumers are actually going to be spending less, their numbers are going to be much softer than they were last year. So I think that could really have some negative repercussions for everybody's valuations. We're not going into, go ahead.
Well, say when it comes to the C-suite and expectations, how much are they going to blame a lot of this on policy out of Washington and the tariffs we're expecting on Wednesday?
Well, they have been blaming tariffs and an uncertain political environment to date, so they're absolutely going to continue to do that. That's a very easy target. And to some level, for a number of these businesses, they do business with China, or they're pulling suppliers from China, or they have relations with Mexico. They have factories in Mexico. So those are absolutely issues that are problematic. But you also are going to have a number of services businesses that have nothing to do with tariffs that will say the same. And that is likely because of the overall impact of tariffs and impacting consumer sentiment, impacting consumer unwillingness to spend, the challenges with employment rates or challenges with wages. Those have been really good numbers in the last few years, and those are the big concerns. If those large macro metrics start to soften, then we may very well be headed to a recession.
Have you heard from any companies that are willing to bring production back to America?
Well, over the years, what we have seen are a number of different things. We've seen other types of nearshoring. We've seen diversion of goods to other Asian countries. In some cases, you may have certain components being manufactured in the U.S., but for the most part, I really haven't seen, kind of any significant investment in manufacturing in the U.S. And if it is, it would be heavily driven with robotics. You see that in some automotive companies like BMW or Volkswagen.
Sucharita, got to leave it there. It's good to catch up. Sucharita Kadali there at Forrester, following that dreadful consumer sentiment number from you, Mitch, on Friday, and looking out for what it means for the retailers in the United States following additional tariffs from the president and more still to come this Wednesday, Liberation Day, 2 days away. Some breaking news out of Paris, France we need to turn to. This is the latest from our team here at Bloomberg. The right-wing leader Marine Le Pen convicted of embezzlement and barred from running to be France's next president. We heard a little bit earlier on this morning that judges at the criminal court in Paris found Le Pen and her party guilty of diverting millions of euros in EU funds to finance activities related to their domestic agenda. And this is the punishment: sentenced to 2 years in prison, 2 more suspended, and given an immediate 5-year election ban, which would take out, of course, any potential of running in 27.
Absolutely. That crushes her ambitions of taking over Emmanuel Macron in 2027. Of course, we have seen her over the course of years, over the decades, really start to rise when it comes to polling in France. But this basically means that not only is she going to be in jail, according to this sentencing, but she can no longer be president. I'm curious what kind of backlash we may see from far-right supporters in France following this court ruling.
And also what we might hear from this administration down in Washington, D.C.
Of course, I think what they're going to say is that this is, quote-unquote, a witch hunt. I believe Marine Le Pen has actually used that phrase, taking from Donald Trump, when she was talking about this case. And I imagine, even though President Donald Trump does have this somewhat warm, many would call it a bromance between Emmanuel Macron and himself, I imagine this administration is going to come out in support of Le Pen.
Marine Le Pen given an immediate 5-year election ban. The latest out of Paris, France, and more updates throughout this morning for you on that particular subject. Next on the programme, we'll catch up with Mike Wilson of Morgan Stanley, Henrietta Trays of Veda Partners, Vikram Malhotra of Mizuho, and Noor Christiani of JP Morgan Private Bank, with a massive week coming up. Payrolls on Friday, lots of data in between. You'll hear from Chairman Powell too, but the main event on Wednesday, April 2nd, so-called Liberation Day in America. From New York, the second hour of Bloomberg Surveillance, up next.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
In 2000, post-Napster, generally everybody wrote off the recorded music industry, including the investment community. And I didn't mind that chapter, because then I got left alone. And actually, I think out of that period, we started to create better art, because the pressure wasn't on from the technology to be the most powerful chapter. And then iTunes came in, and iTunes, to Apple's credit, did have a boutique taste mentality about the store, which meant that I think they understood. I can tell you from that period that the artists that came through were of a very high quality, because it was encouraged to be boutique. Now, ironically, this chapter has made us more money times 5 than the iTunes chapter and the post-Napster chapter. But an algorithm tells you what you want, not what you might like. And there's a difference between what you want, but with streaming, the downside is you have incredible penetration, and we have hundreds of millions of people around the world. And so that has been very lucrative as a business.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
There's a scarcity of certainty.
After April 2nd, as long as we stick to that date, a lot of that uncertainty is now behind us.
You'll get certainty to some degree, but who's to say that April 3rd it doesn't all change? Uncertainty is the policy.
There will still be uncertainty. There will still be volatility.
We're in this deep fog. Pull over to the side of the road and your blinkers on kind of uncertainty.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance starts right now, and we start with some scores. Equity futures on the S&P 500 negative by 0.9% on the Nasdaq. The Nasdaq looks like this. The Nasdaq 100 down by 1.25. The Russell down by 1.2. In the bond market, 2-year, 10-year, 30-year, we receive a bid. Yields down by 6 basis points at the front end, down by 5 on 10s, down by 5 on 30s. Your week ahead is absolutely stacked full of economic data, including payrolls on Friday and an address from Fed Chair Jay Powell going into the weekend. But before we get there, it's all about Wednesday, Liberation Day. It's April 2nd.
It's April 2nd, and it feels like the mood has shifted. What we've heard from the president last week was that he's willing to be lenient, he's willing to be flexible. The reporting now seems they're going back to what he's been speaking about for months on the campaign trail, honestly, for decades, when it comes to tariffs, a universal tariff. Now, the big question is Wednesday the start of a negotiation when it comes to U.S. and their trading partners? Does Trump come in with a very maximalist approach, or is this going to be the new trade rules of the road for this administration going forward?
We've all got to wake up to what's actually happening, and what's happening is more tariffs, repeatedly, over the last few months. And what's happening on Wall Street, more revisions. This from Goldman Sachs. So David Kostin is now at 5,700 year end, started the year at 65, dropped that to 62 only a month ago. 5,700 is the year-end outlook. Then you've got Jan Hansius and the team at Goldman Sachs looking for this stagflationary mix that's getting everyone's attention. 3.5% on PCE, just 1% on GDP.
And what's driving a lot of that is the fact that for the second time this month, Goldman Sachs raised where they expect the tariff barriers to go. So they are expecting higher walls to go up when it comes to this administration. It's not just also on Wall Street, Jonathan. Over the weekend, CBS polling, a majority of Americans are saying they want this president to bring inflation down, costs down of goods and services, and focus less on tariffs.
Had a few reports over the weekend, the Washington Post saying that the president wants to go big. He's pushing the team to go large. Politico reporting that no one in the administration knows what the president is going to do in 2 days' time.
Well, Kevin Hassett, his NEC director, had this to say on Fox News. I can't give you any forward guidance on what's going to happen this week. The president has got a heck of a lot of analysis before him, and he's going to make the right choice, I'm sure. Now, is that the president has made a decision that I'm not fully on board with, or is that we actually don't know what the president is going to decide? There is a key report coming out tomorrow. A question that I'm talking to a lot of folks about in Washington is whether or not the report is going to be made public. When Trump came into office, he told his trade representative he wants a full analysis on how the U.S. is dealing with other trade partners when it comes to trade deficits, reciprocity, everything under the sun. That report goes in front of the president tomorrow, and then I think he'll make his final decision.
Not many people want to be long going into that event. Speaks to the move we're seeing this morning. We're down by 0.9% on the S&P. Coming up this hour, Mike Wilson of Morgan Stanley with stocks on a 3-day slide. Henrietta Trays of Veda Partners as the world prepares for Liberation Day, and Vikram Malhotra of Mizuho on why AI data center concerns may be overblown. We begin this hour with stocks softer as trade uncertainty hangs over markets. Mike Wilson of Morgan Stanley writing, this week's reciprocal tariff announcement it's likely a stepping stone for further negotiations as opposed to a clearing event. Mike joins us now for more. Mike, good morning.
Good morning, John.
Why is that distinction important?
Well, I think that everybody's looking for like a final piece here. This is gonna take time, and not unlike a lot of the other policies that have come out this year. Like this is what we kind of signed up for, right? I don't think what the president has done has really been surprising. All of the policy changes so far have been growth negative, and that we've likened this to a new CEO coming in, right? They want to restructure the company. They're restructuring the company. They're going to kitchen sink it. And then they're going to try to make their plan work for next year. So this is going to take some time. And this level that we're at now is critical from a market standpoint, not so much from the administration standpoint. I think that's also something to acknowledge.
It's also very on brand for Trump to take a maximalist approach in the very beginning. But how messy could it be if he comes in with this maximalist, aggressive approach, and then we have retaliation from trading partners?
Well, look, it's the NAFTA. So, it's the best alternative to a negotiated agreement, and the BATNA, and that is classic negotiating tactic. You come in and way over here to the right with the hope of kind of settling in the middle. So I don't think that's unusual either. The response from trade partners is that means they're engaging. Okay, so that's how you get people to engage in your discussion. You come out with a big splash. They have to come to the table and negotiations begin. We're not even at the table yet. Okay, so that's why this is going to be very uncertain for a period of time.
I think some countries think that they are at the table because they sent a few representatives here the past few weeks, but I agree with you. It really hasn't started. So what do you do if you're an investor?
Well, you've done what we've sort of done. You avoid the areas that are going to be most affected. Consumer discretionary goods, and that area has been hit the hardest, so maybe that's getting a little bit extreme. I would say, defensively positioned, high quality, that's been our core portfolio. Now, we've made some trading calls lately that would have gone against that. Some of those worked, some of those didn't work. But I think at this point, you want to be up the quality curve. You want to be in businesses that can kind of mitigate some of these concerns. You have pricing power. You have the ability to kind of move production around. You can take inventory on to kind of buffer this for 60 or 90 days, which we've seen all of those mitigation strategies, something we wrote about in our note today. So those are the kind of companies we want to own in this period of time. I do believe there will be a clearing event at some point this year, but we're not there yet.
Some of the changes you have made that are working, let's talk about them. International, DAX this morning, down 2%. Nikkei overnight, down 4%. International starting to turn. Subtle change from where we were over the last month or so. What's changing?
Well, that's right. And so last week's note, we kind of made the call that U.S. probably does better than these other regions because at the end of the day, those regions you mentioned are most sensitive to global trade, particularly Japan. So the fact that that was down 4%, I think, is another sign that, hey, actually the market now is laser focused on this tariff or trade issue as opposed to some of the other issues that it's been kind of worrying about here. So that relative value, if you will, still looks good to us. It may happen in a down tape, okay, which is also something to consider because the U.S. is still the highest quality market in the world, and in a uncertain world, high quality will outperform.
But you think those European longs that have built up over the past few months, they might be in trouble here?
I think that's right. I think there's a little extension. Our European strategy team is in the same page. There are some good things going on in Europe that haven't been happening for decades potentially. But boy, that's going to take even longer than this sort of tariff negotiation. You're talking about countries spending more money on fiscal deregulation. This is a multi-year transition in the stock market. Some cases are up 15, 20%.
So besides Rheinmetall or any other industrial military company in Europe, do you like anything there?
Well, I think the financials have been still a place to think about that have a potential structural change, a benefit in that regard. I think things that have levered to the consumer, but once again, these kind of got extended, and from my standpoint, I think there's better value now in the U.S. in some of these areas.
I'm sure you saw the new numbers coming out of Goldman Sachs and the team. New forecast from Jan Hatzius. If we can just throw them up on the screen. 1% on GDP, 3.5% on PCE. That's a stagflationary mix. What are you telling clients that are asking you about how we would trade stagflation in America?
We're not quite in the stagflation camp. We're more in the camp that expectations are probably not where reality is, which is that growth is worse than people thought, and inflation's a bit stickier, and that's how we came into this year. So we didn't mess around with our year-end targets, but we have been messing around with our short-term targets. So we're in that 5,500 to, I would say, 58, 59 now. We've kind of chopped off the upper end of that for the first half of this year. I'm not willing to throw in the towel yet completely on the full year because, as we've been saying, the good stuff of the policy changes that we expect could start to feed into the equity markets by year end. Could we push that timing out, 3-6 months? Sure. But right now we're still in that 5,500 to 6,100 range with probably a truncated upper band. And now if you get universal tariffs, which is something that we talked about in this morning's note, then that lower half, that lower end of the band maybe comes down. So we're, if we break down this week and universal tariffs are the reason, we could see something even lower than 5,500 in the short term.
Can we talk about the rebalancing you're expecting, though? The ultimate vision of this administration and why you still believe the more complete policy mix is still bullish?
Yeah, I think it's constructive. I'm not sure it's wildly bullish because, valuations were probably the biggest constraint coming in. I think it's bullish for a lot of parts of the market that have underperformed for the last 3 or 4 years. I mean, our vision, or I think the administration's vision, quite frankly, is very simple. They want to affect a slowdown in government. They want to kind of liberate the private economy through things like deregulation, keeping tax rates lower. Maybe tariffs are part of that storyline, fine. And that transition from kind of public government allocation of resources to private enterprise allocation of resources actually leads to a broad